Welcome to Yahoo Finance. It is Wednesday, December 18th. I'm Julie Hyman. That is Josh Lipton. And of course, we are moments away from the Federal Reserve's decision on interest rates. As we take a look here across markets ahead of the headlines, we are seeing a little bit of a bump for stocks here, not a huge one. The broad expectation, of course, Josh, is that the Fed will cut interest rates by a quarter point. That will be announced today. We're also going to get the updated so-called dot plot, the summary of economic projections, and a little more suspense around that.
Yeah, for sure. So to your point, Julie, the expectation is we get a cut. We wait for that summary of economic projections. Does that signal a slowdown in reductions, right? That's what we're searching for. With those dots, I mean, some have argued, I think even Jay Powell, I think, has argued they can have limited value because they do ultimately represent.
But that doesn't stop anybody from looking at it.
You're looking for clues, you're looking for signals, you'll take whatever you can get. And of course, all attention on the presser as well, and how Jay Powell navigates a lot of questions.
Yes, so a couple of questions we're going to be looking for, a couple of things. We're looking at the dot plot. We're looking at what is the so-called neutral rate? That's what the Fed's trying to get to. The rate at which the economy, it won't contract or expand the economy, just kind of the nice neutral rate. But to your point, he might also get a lot of questions about politics, about fiscal policy. How could tariffs affect inflation? How could any kind of crackdown on immigration affect inflation and affect economic.
And the truth is, of
generally.
course, with all that Trump is coming back in, to your point, range of uncertainty, taxes, regulation, immigration, tariffs, he's playing, they're guessing just as much as anybody else, which is part of the issue here.
Well, and Jay Powell has kind of made that clear. There are just a lot of uncertainties right now, and so he usually deftly dodges those kinds of questions. He likely will do that again. All right, well, our Jennifer Schonberger is standing by there with the decision.
25 basis point rate cut, the Federal Reserve trimming its benchmark interest rate by a quarter percentage point to a new range of 4.25% to 4.5%, and scaling back the number of rate cuts for next year. Officials now see 3 rate cuts next year, down from 4 previously forecast. 10 officials estimated 3 rate cuts next year, while 3 saw 2 cuts next year. 3 saw 4 cuts, and 1 saw no cuts. This as officials see the so-called neutral rate, that's the rate that neither spurs nor slows growth, up 0.1 percentage point to 3% from 2.9% previously. Officials saying in their statement, quote, "In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks." The statement including the wording "extent and timing" to indicate that the Fed may not cut at consecutive meetings going forward and will remain more cautious. Now, the outlook for interest rates comes as officials now see inflation ending 2025 at a higher level of 2.5%. That's up from 2.2% previously forecast. The unemployment rate is seen ticking down to 4.3% from the previous forecast of 4.4%. Economic growth expected to remain roughly the same at 2.1% next year, up from 2%. Officials see inflation ending this year at 2.8%, up from 2.6% previously forecast, while the unemployment rate is seen ending the year at 4.2%, where it stands right now. That would be down from 4.4% they originally forecast. This decision was a split vote. Cleveland Fed President Beth Hammack dissenting, saying she would have preferred to hold rates steady. Her dissent marks the second since the September policy meeting. Back to you.
Thank you, Jennifer. All right, so Julie, the Fed does cut by a quarter point, suggests fewer reductions ahead. I think we had plenty of folks on our own show, economists, strategists, who argued you could certainly make the case for that. The economy is growing, as we have talked about a lot. Inflation, judging by some recent prints, looks sticky. Maybe we kind of stalled out here on our way back, that 2% target. And as we were just discussing, throw in the mix President-elect Trump, lots of uncertainty about fiscal policy, too.
Yeah, and there have certainly been some strategists, economists who have said they shouldn't be cutting today, all things being equal. So that then, of course, makes makes the summary of economic projections for next year sort of make sense in that context, that they are not planning or projecting that they will cut as much. I think the dissent is also important there. Beth Hammack, and that's in line with some recent comments that she has made in the press, that she didn't necessarily think that the Fed should indeed be cutting here. But we don't get a lot of dissents, and we haven't gotten a lot of dissents at the Powell Fed. So it is notable that we are getting that dissent, and maybe that also presages more of what we could be seeing going into next year. You saw stocks there cut their gains a little bit, but as usual, in the wake of a Fed decision and a release of a dot plot, you tend to see some gyrations before they settle out after the press conference.
We have just the man to walk us through those market responses. We really do. Because for more, let's get to Yahoo Finance's Jared Blickery. Jared, give us the reaction response to the markets, those headlines.
Thank you, Josh. I was looking behind me there. Thank you for the intro. We got a mixed market here. We did see a little bit of movement to the downside. The Nasdaq is in negative territory, but these are very tiny moves here. We're only talking about 2 basis points to the downside, and we weren't looking at that much green earlier on. And I should mention, we've seen the Nasdaq closing at records recently, not yesterday, but recently. And then here's the Dow. The Dow is the best off of all 3 majors, and it has been down the last 9 days. We've been talking about that losing streak since 1978, the worst one since then. Well, might be ending it today, but we've got a few hours to go, and you got to think there's going to be some volatility when Powell steps up and starts talking. That's usually when we see the real market movements, but we also get a little taste here. So let's look at the bond market. Now, these are futures. So the 2-year U.S. Treasury note future is heading down, which means its yield is heading up, maybe pricing in those fewer rate cuts than we originally thought. So that's the 2-year, and we're also seeing a similar movement in the 10-year, but even farther. So this is going down. That means the yield is heading up. And if we take a look at the gold market is telling, not as concerned about inflation as it was, and gold is at a relatively close to its recent record highs here, around $2,700 per ounce. Still elevated, still looking at 28% year to date, but intraday we are seeing it head down just a little bit. Seeing a very similar story in silver futures, and not that we always see crude oil react, and it's not today, but sometimes we do see a reaction there. So crude oil already sitting on gains of about 1%, and for all intents and purposes has not moved. Also, not yet seeing a movement out of Bitcoin. We'll have to see if that lights up later, but little crypto action and look before the big show at 2:30 here Eastern.
Yes, and of course we'll check back in with you later on. Thanks a lot, Jared. Let's discuss more now on the Fed's latest rate cut. We've got Guy Labat, Jenny Montgomery Scott, head of fixed income, along with Luke Tilley, Wilmington Trust chief economist and former Philadelphia Fed economic advisor. Luke, I'm going to start with you here because you are still expecting a pretty steady trajectory of cuts next year. Is the dot plot changing your outlook on that front?
No, I don't think so. I think that the members of the FOMC are rightly a little bit cautious about inflation given the numbers that we've gotten, but I think they're a little bit too sanguine about the labor market. The labor market has slowed significantly. If you look through all of these storms, private non-farm payroll growth is now just 108,000 on average over the past 6 months. And you also have labor demand falling precipitously. So I think that the labor market is going to end up having them cut faster than even they are saying today. And we're expecting those rate cuts to come through until September of next year, at every meeting until next year. And we'll be at neutral before we get to the end of 2025, Julie.
Guy, I want to bring you in here as well, get your quick response to the news, Guy. What the Fed did here is what you expected, Guy. Was it the right moves, in your opinion?
Well, I do my best not to judge whether the Fed is doing the right thing, because that makes them more likely they're going to miss whether we think they're doing what they're going to do. Poorly phrased, but you get the point. I think the sort of underlying story, and this is a little bit buried within the SEP, the economic forecasts, is if you take a look at the Fed's inflation expectations for 2025, the median of those expectations bumped up considerably, but the range actually shifted somewhat higher as well. So the central tendency expectation for core PCE inflation for 25 is now between 2.5% and 2.7%. And look, if that forecast comes to pass, which it's very, very hard to judge the inflation outlook 6 or 12 months hence, if that forecast comes to pass, I think 2 cuts is more likely to emerge than 3 or 4 or even more than that in 25.
And Guy, what effect does that then have on the bond market, right? Which is your bread and butter here, looking at what happens in fixed income. How is that going to affect? Because what are we seeing currently priced into fixed income?
Yeah, right now, or at least heading into the meeting this morning, there was round numbers about 3 cuts priced in 2025. And frankly, I don't think, and I want to separate the put some distance between what I anticipate is likely to happen and what the markets are going to price. Because Luke's point a minute ago, the markets are going to continue to price some downside risk of economic slowdown. I'm just not convinced it emerges. So the markets are probably going to leave that pricing somewhere in that 3-ish cut range for 2025, even after this announcement. And I don't think Powell is going to guide terribly different from that at his 2:30 press conference.
Luke, back to you. I'm just curious. They cut as expected. Luke, I'm wondering, what are the risks of doing a cut, in your opinion?
I don't think there's any risks of doing a cut right now. I think there's a risk that they're saying that they're not going to cut rates even more. So I understand that the inflation data has stalled out a little bit, but if you just separate the shelter component and look at all other components of inflation, the Fed has already been at target for about 18 months, whether you're looking at PCE or CPI. It's really just that shelter component that is keeping things high, and we know the lags from market rents. So right now, consumers are not really in any kind of position to keep inflation accelerating. And with the labor market worsening, I think that that they need to end up revising downwards here and be cutting more because the risk is that they are too tight for too long. Real yields are still very high compared to the past 10 or 12 years. And it's putting a pretty solid brake on the economy right now. And that's the real risk, Josh.
Luke, it's really interesting because I think fair to say the consensus is not where you are right now, right? And it seems like the crowd has sort of looked at the past couple of years and said, we kept underestimating growth. We're not going to make that mistake again. Do you think that is the wrong lesson to take away right now? We're sort of fighting the last war, if you will?
Yeah, I do think it is the wrong lesson because the real lesson to take is even when growth is strong, inflation has been coming down. That was the real mistake of 2023, is not realizing that inflation could come down. That's coming from companies getting more productive, from people joining the labor force. And I expect that now we're going to have the economy slowing down and inflation will keep coming down. And that's why I think the Fed will end up cutting a lot more than they're saying today.
Guy, what did you make of the argument? I did hear some making this, which they should have paused here, Guy, because the fiscal policy outlook is so uncertain with Trump moving back into the White House, taxes, regulation, tariffs, immigration, so unclear right now, Guy. That's why they should have held off. What's your response to that line of thinking?
Yeah, I mean, to borrow a phrase from Lael Brainerd, when in a dark room, move slowly. You don't want to bark your shit on the coffee table, which I guess the coffee table is an economic slowdown in this case. But the point being that with an uncertain outlook, the natural tendency is to move the trajectory of interest rate changes a little bit more gradually. And I don't see a lot of downside to that right now. Now, Luke, I know you made the argument that labor activity is slowing considerably. It doesn't strike me as an immediate problem, certainly not one that's going to be resolved with aggressive downside action in the interest rate markets, not in the very short term. I suspect really what we're going to see is just in response to the potential fiscal changes in 2025, most of which will hit in late 25. In response to those changes, the Fed's just going to act more gradually rather than more aggressively. And today is sort of the last, in my expectation, of the consistent 25s at every meeting. And we'll probably slow down in early 25 to perhaps 1.25, perhaps just 2 for the full year. And that's that gradualism that I mentioned a moment ago.
Luke, how are you thinking about the fiscal picture and how it plays into your scenario that maybe the labor market's going to be weakening more?
Yeah, I think that there's a good chance that we're going to get tariffs, and I don't really think of them as inflationary. I think of them as raising the price on imported goods, which is not the same thing as inflation because consumers are in a place right now where if the prices of those imported goods go up, then they're just going to be spending less somewhere else. I'm much more concerned that tariffs would lead to a recession much more than they would lead to broader inflation over a longer period. So I think that fiscal policy needs to be watched very closely, and it's at more risk of harming the economy when it comes to tariffs. Of course, there are other policies that could give a boost to the economy, but we really don't know how it's going to turn out. We have to watch how that narrow majority in the House for the Republicans goes forward with all of these policies, and I don't think anybody can predict that right now.
Guys, thank you so much. Great perspective here, first blush from the Fed decision. Luke and Guy, appreciate the time today.
Thank you.
Coming up, we'll get you set for Fed Chair Jay Powell's press conference following that 25 basis point cut. Stick around, more Yahoo Finance still to come.
All right, markets lower now following the Fed's latest decision to cut interest rates by 25 basis points. For more, let's bring in Michael Darta, Roth Capital Partners chief economist and macro strategist. Michael, it is always good to see you. So the news is out. The Fed does issue that cut, Michael. Does signal also fewer reductions next year than previously expected. But give us the Darta instant reaction, Michael. What do you make of it?
Thank you for having me on. I think this was generally as expected. The markets were fully priced for a 25 basis point rate cut, but the dots did move around and the Fed's projections moved around, and they moved around in a way that was, hawkish on the margin. So, some folks have been calling this the potential for a hawkish cut. I think that's basically what we have with the updated projection materials. And we anticipated that the Fed was likely going to really slow things down after this rate cut. And that's just based on the criteria that Fed Chair Powell laid out for the rate cuts that have happened to date and what he has said recently. And, we can go through those details, but his most recent comments were that the economy was outperforming what the Fed expected when they started cutting rates in September. That's really all we needed to hear to assume that they were probably going to go on a multi-month pause after this move today.
Michael, I don't know if you just heard the conversation we were having with Luke Tilley and Guy Labat, but Luke seems to think that the labor market is indeed slowing and that their risks, the economic risks, are more to the downside right now. What do you think of that view and the view that the Fed doesn't seem to feel that way?
I have a lot of sympathy for that view, as you know. The economy has held up better than I thought that it would. I mean, we have avoided any kind of a obvious or technical recession so far, which is pretty remarkable considering the previous Fed rate hikes and the 13-month pause at peak policy rates, and all of the other signals that we were getting that you tend to get before you go into a downturn. What's really strange about the current backdrop is, and I did hear that conversation, really good one, no doubt the labor market is cooling. So I'll even give you a different statistic. The previous guest mentioned private sector payrolls, but if you take healthcare jobs out too, so government and healthcare, non-cyclical sectors, private employment growth is running at about 55K over the last 6 months. That is half the level that we were seeing pre-pandemic, with an economy, at full employment and inflation at or somewhat below the Fed's target. And these growth rates have come way down. If you look where the 6-month growth rates were, say 6 or 9 or 12 months ago, this is a pretty significant and material cooling in the labor market. The unemployment rate now has leveled off for the last few months, but was starting to hook upward in a way that you only see at the beginnings of recessions this past summer. And I think that's one important factor in the Fed starting out of the gate with that 50 basis point cut in September, because it looked like maybe they were falling behind the curve and you had the labor market really cooling sharply. So now it's a little bit more of a mixed bag. The unemployment rate is leveled out for the time being. It does look like the underlying pace of job growth is slowing, but some of the other data has been a bit better. GDP tracking estimates for the fourth quarter are up in the 3s. So, people look at that and they look at the stock market today, excluded, and they kind of scratch their head thinking, what is the sense of urgency here? Why is the Fed doing 100 basis points of rate cuts when everything seems to be fine? But I do think the underlying steam in the labor market is easing up. And the risk here is that the Fed pauses. We end up with those supply side tailwinds potentially turning into headwinds, and then they find themselves behind the curve, and cycle risk starts to rise again. I mean, that is a significant risk for 2025 in our estimation, and you have incredibly high equity valuations, so a lot of smooth sailing and good news have been priced in.
Michael, I'm just curious as you're talking there, kind of broader question. Why didn't Fed policy, Michael? I mean, they took rates up hard and fast there. Why didn't it impact the economy the way maybe central bankers or policymakers expected it to?
Yeah, great question. So I would say it really depends on what we're looking at. If you look at nominal GDP, and it's really nominal variables that the central bank controls over the long run, nominal growth has actually slowed very sharply, but it didn't crash. It slowed from double-digit growth rates early in the recovery. At the end of 2022, we were high single digits. Right now, nominal growth is running at about 5%. That's like a great moderation growth rate, sort of a Goldilocks growth rate. And so the Fed has constrained the nominal economy. At the same time, real growth has actually accelerated since the end of 2022. And that's what some people are saying, hey, the economy didn't even slow at all, it actually accelerated. Well, that's only half right. The real economy accelerated because productivity growth started to pick up in 2023 after a 2-year slump. And so those positive supply shocks at a time when the Fed had just completed its monetary tightening, I think have gone a long way to pave the way for this extended soft landing period. And what happens next is a big question mark. If the Fed pauses into an environment where those temporary tailwinds start to let up, or we get policy shocks from tariffs and a clampdown in immigration, things could get a bit dicier. But it's a great question. I think the answer is that nominal growth slowed but didn't crash. And at the same time, that slowing was met with an acceleration in productivity growth. And that is, really the combination of the two gave us this immaculate disinflation where inflation came down, but no obvious recession. And, with this AI frenzy going on, that also fed into the storyline with productivity rebounding that, that many people want to hear about the outlook for AI and productivity and growth.
So the outlook remains still a little uncertain for now. Michael, we got to leave it there, but we'll catch up with you very soon, I'm sure. Thank you.
Thank you.
Joining us now with her reaction to the Fed's decision is Loretta Mester, Cleveland Federal Reserve, former president and CEO. Loretta, thank you so much for being here. I would love to start with Beth Hammack, the Cleveland Fed president who dissented from this decision. What are you seeing in Cleveland? What's going on in Cleveland that would lead her perhaps to dissent from the overall decision to cut rates?
Well, there can only be one Cleveland Fed president at a time, and Beth is that. So I'll let her speak for herself once the blackout period goes off. But this was a decision of the Fed. I'm sure they had a robust discussion at the meeting because there were some indications that inflation has been stalling out, at least been more sticky than they anticipated it being. And at the same time, despite the previous conversation, the downside risks to the labor market that they were seeing in September have eased off a bit. So I'm sure they had a robust decision about whether they should go ahead and do the 25 basis point move at this meeting or whether they should, begin pausing. And I think what they did is they hit a very good point in the sense that, look, one way to think about this is, they had told everyone that they thought 100 basis points of recalibration was probably required, and they fulfilled that. But at the same time, they signaled that, look, we're going to be going more gradually. And the chair had said that before the meeting. So this wasn't a surprise. They followed through on the communications that they indicated in this intermeeting period, which was, look, we've done the recalibration. We've gotten, the funds rate down 100 basis points. Now we're going to have to really look at both parts of the mandate and look at the risks around that mandate. And, perhaps we're going to go slower. And indeed, in the SEP, we see that at least the median path has one fewer 25 basis point cut for next year than the September SEP. So the messaging, I think, is a good message, which is, look, we've done a recalibration. We got the funds rate down, which was appropriate given how far down inflation has come. Now we're in this point where inflation still has some more room to go. We may have to keep policy a bit more restricted than we anticipated to get it all the way back down to 2%. But we're in a good spot with monetary policy where we can react. Whether the downside risks to employment get realized, then we will cut a little faster. If it's really the upside risks to inflation that get realized, then we'll go a bit slower. So I think monetary policy is well placed at this point.
Loretta, the decision, of course, does come as inflation is holding above the Fed's target there. So I am curious, when you look out, the trajectory of inflation from here, Loretta, looks like what to you?
Well, I think there's still a case for it coming down. I mean, some of what's happened is, there are base effects in those numbers, but I think there are a lot of uncertainties out there. One is, of course, the fiscal policy actions. We don't know exactly what they are yet. We'll get more information over the next, this intermeeting period up to the January meeting. We'll know a little bit more about that. And then the Fed can begin to take that into account. And that may have effects on both sides of the mandate, not only on the inflation part of the mandate, but also on the employment part of the mandate, with the immigration aspect of it, the tariff aspect of it, and the spending and taxing parts of it. So we'll have a little more information on that, and that's why the Fed can pause and assess at this point because its policy is well in place. I think that, they're right in the sense that median seeing that inflation will come down. I think it'll take longer than was earlier anticipated, given some of the data that we've seen, but I do think it's still on that path. But they'll be able to adjust that as we get more information about how the economy is actually going. So I think they're in a good spot. And then they'll be able to react either to, if inflation does appear to be on the upside, they'll just hold at a restricted level for longer than they anticipated.
I mean, I guess, how much buffer do you think they have, right? Because you have to wait until the policies are actually announced instead of just, talked about in advance. Then you have to wait to see what actual effect they have. Are there any areas that you're watching, whether it be on the employment side or on the inflation side, that might give you pause that they don't have that luxury of time to wait, if you will?
Well, when the chair says we're not going to speculate about what the fiscal policy was and then react to our own speculation, I think that's the right tact. But that doesn't mean that as information comes out, they won't be looking at what do they expect, or forecasting, well, what kind of effect could that have on our dual mandate goals of inflation and employment, and therefore build it into their forecasts and therefore react, with policy appropriately given what their forecast is. So I do expect the forecast to begin incorporating those fiscal policy initiatives when we have more information about them. But right now, we just have really what was talked about during the campaign. We don't really have President Trump's actual proposals yet. And so once that becomes part of it, there'll be analyses that are done, and FOMC members will start putting that into their forecasts, and therefore it will start impacting some of the policy decisions that the Fed has to make, because as you say, policy is forward-looking. But they're going to, just the way data comes in, it's not about what a data point tells you about today's economy. That's already done. It's really about what is that telling you about the outlook for the economy going forward. And that's what the Fed will react to, and that's what really determines appropriate policy, that and their forecast of the risk around hitting their dual mandate goals. So we will begin to see the Fed incorporating this into their forecast for the economy, and therefore it will begin to affect what they view as appropriate policy going forward. And we may know a lot more, once the inaugural happens and we see what some of those early actions will be from the Trump administration.
Loretta, we have to leave it there. Thank you so much. Of course, the press conference is going to be beginning in a few moments. Appreciate your time today. And we are awaiting those comments from Fed Chair Jay Powell. Undoubtedly, he's going to get at least some questions about the incoming administration. He sort of deflected those questions, of course, at the last meeting, saying, we're not going to talk about fiscal policy. We're not going to talk about the election. We're going to focus on the economic data. Presumably, he will take a similar tack, but that doesn't mean he's not going to get those questions.
Oh, he'll get a lot of them. And then at some point, Jay Powell lets you know in his own way that he's
done.
He's really done. Listen, we'll get all attention to the presser, more color and commentary about the decision. Very interested, of course, his broader takes about the economy, about the labor market. He's going to get a lot of some questions we just asked Loretta. Inflation, decision does come here as it's above where Jay would like to see it. What's the trajectory look like from here? Puts and takes. And yes, plenty of questions about President-elect Trump and fiscal policy, however uncertain that still may be here.
Yeah, as we go into the press conference, we see stocks selling off a little bit more sharply here than they had been. Right after the decision and the dot plot came out, we saw kind of bouncing around the unchanged line. But now we've got the Nasdaq down 0.8%. We've got the S&P down 0.6%. The Dow, which had broken that losing streak, is down right now. Let's listen in to Jay Powell.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has moved much closer to our 2% longer run goal. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. To that end, today, the Federal Open Market Committee decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by 0.25 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of about 2% over the next few years. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 173,000 per month over the past 3 months. The unemployment rate is higher than it was a year ago, but at 4.2% in November, it has remained low. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than in 2019. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.2% at the end of this year and 4.3% over the next few years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.4% this year and 2.5% next year, somewhat higher than projected in September. Thereafter, the median projection falls to our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 4.25% to 4.5%. We've been moving policy toward a more neutral setting in order to maintain the strength of the economy and the labor market, while enabling further progress on inflation. With today's action, we have lowered our policy rate by a full percentage point from its peak, and our policy stance is now significantly less restrictive. We can therefore be more cautious as we consider further adjustments to our policy rate. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of next year and 3.4% at the end of 2026. These median projections are somewhat higher than in September, consistent with the firmer inflation projection. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can ease policy more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. On a technical note, we lowered the offering rate on our overnight reverse repo facility to align it with the bottom of the target range for the federal funds rate, its typical configuration. Technical adjustments of this kind have no bearing on the stance of monetary policy. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Gina.
Gina Smialik with the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit about why officials think it's appropriate to cut rates at all in 2025 if inflation is expected to remain firm throughout the year. And what would you expect at this point the timing might look like? Would a January cut potentially be possible, or does a pause next month seem more likely?
Well, so let me start by saying why we cut today and then move to 2025. So I would say today was a closer call, but we decided it was the right call because we thought it was the best decision to foster achievement of both of our goals, maximum employment and price stability. We see the risks as two-sided, moving too slowly and needlessly undermine economic activity in the labor market, or move too quickly and needlessly undermine our progress on inflation. So we're trying to steer between those two risks. And on balance, we decided to go ahead with a further cut, and I'll give you some details on why. Downside risks to the labor market do appear to have diminished, but the labor market is now looser than pre-pandemic, and it's clearly still cooling further, so far in a gradual and orderly way. We don't think we need further cooling in the labor market to get inflation down to 2%. Job creation is now well below the level, or certainly below the level, that would hold unemployment constant. The job finding rate is low and declining, and other measures such as surveys of workers and businesses, quits, things like that, broadly show a much cooler labor market than we had in 2019. It's still quite gradually cooling. So we keep an eye on that. Inflation, we see that story as still broadly on track, and I'll tell you why. We've made a great deal of progress. 12-month core inflation, as I mentioned, through November is estimated at 2.8%, down from a high of 5.6%. But 12-month inflation has actually been moving sideways as we are lapping the very low readings of late last year. Housing services inflation actually is steadily coming down now, albeit at a slower pace than we might like, but it has now come down substantially, and it is making progress slower than hoped. And we've had recent high readings from non-market services and some bumpiness for goods. So I'll just say, so remember that we coupled this decision today with the extent and timing language in the post-meeting statement that signals that we are at or near a point at which it will be appropriate to slow the pace of further adjustments. You ask about 2025. I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation that inflation will be higher. You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut. I think the actual cuts that we make next year will not be because of anything we wrote down today. We're going to react to data. That's just a general sense of what the committee thinks is likely to be appropriate.
Sorry, just one quick follow-up. Why, I guess, would you make those cuts? Like, what would be the trigger to cut?
So we're to cut further after this point. I would say it this way: we've reduced our policy rate now by 100 basis points. We're significantly closer to neutral. At 4.3% and change, we believe policy is still meaningfully restrictive. But as for additional cuts, we're going to be looking for further progress on inflation, as well as continued strength in the labor market. And as long as the economy and the labor market are solid, we can be cautious about as we consider further cuts. And all of that is reflected, to your question, in the December SEP, which shows a median forecast of down 2 cuts next year compared to 4 in September.
Howard Schneider with Reuters, and thanks for the opportunity to ask you a question. So this does seem similar to the dynamic in 2016 during the last transition to a Trump administration, where the committee saw slightly tighter policy, in part in expected anticipation of the fiscal policy stance that was seen evolving over the year. Some of it was a data mark-to-market exercise, and some of it was anticipation of fiscal. What's the split on this one? How much of this was accounting for inflation data that was coming in, and how much of it is expecting that there will be inflationary fiscal policy next year?
I'd say I'd point to 5 or 6 things, and let me start by saying that we think the economy is in a really good place, and we think policy is in a really good place. Let's remember that the economy is growing 2.5% this year, that inflation has come down by 50% from 5.6% to 2.6%. Headline inflation is 2.5% on a 12-month basis. We're actually in a really good starting place here. But since, so what's really driving the slower rate cut path? First thing is growth is stronger, right? The economy grew faster in the second half of 2024 so far than we had expected, and is expected to be above what our expectations in September next year as well. Unemployment is lower, and in the SEP you'll see that participants think that the downside risks are less and uncertainty is less. So that's more strength, right? Inflation is higher, as we talked about. Inflation's higher this year. It's also higher in the forecast next year. I'd also point out that we're closer to the neutral rate, which is another reason to be cautious about further moves. But then getting to your point, there's also there's uncertainty. Uncertainty around inflation, I pointed out, is actually higher. It's also in the case of some people, the way I would say it is this. Some people did take a very preliminary step and start to incorporate highly conditional estimates of economic effects of policies into their forecasts at this meeting, and said so in the meeting. Some people said they didn't do so, and some people didn't say whether they did or not. So we have people making a bunch of different approaches to that. But some did identify policy uncertainty as one of the reasons for their writing down more uncertainty around inflation. The point about uncertainty is it's kind of common sense thinking that when the path is uncertain, you go a little bit slower. It's not unlike driving on a foggy night or walking into a dark room full of furniture. You just slow down, and so that may have affected some of the people. But as I said, there's a range of approaches on the committee.
If I could follow up on that, you mentioned the risk and uncertainty indexes toward the back of the document. The upside risk to inflation jumped quite substantially. The only thing really that's happened, you mentioned that the disinflationary story remains intact, yet the risk weighting has jumped to the upside. The only real thing that's happened is November 5th in the meantime. Is it fair to say that that's what's driving the higher sense of upside risk on inflation?
Actually, that's not the only thing that's happened. What's happened is that our forecasts for inflation for this year, I think, are 0.5 higher than they were in September. So you had 2 months of higher inflation in September and October. As I mentioned, November is back on track, but once again, we've had a year-end projection for inflation, and it's kind of fallen apart as we've approached the end of the year. So that is certainly a large factor in people's thinking. I can tell you that might be the single biggest factor is inflation has once again underperformed relative to expectations. It's still going to be between 2.5 and 3. It's way below where it was, but we really want to see progress on inflation. As I mentioned, as we think about further cuts, we're going to be looking for progress on inflation. We have been moving sideways on 12-month inflation as the 12-month window moves. That's in part because inflation was very, very low measured in the fourth quarter of 2023. Nonetheless, as we go forward, we're going to want to be seeing further progress on bringing inflation down and keeping a solid labor market.
Chris.
Thank you, Chris Rugaber at Associated Press. Thanks for taking the question. In September 2018, the Fed staff in the Teal book discussed a policy of looking through any new tariffs as long as there were one-time increases and inflation expectations remained anchored. Could you comment on if that analysis remains effective and any other thinking on tariffs generally that you can share?
So I do think that the September 2018 Teal book alternative simulations are a good place to start. I happen to have brought them here with me today. I'm sure you have them too. They're a good starting point, and I would just say, it's 6 years old analysis, but nonetheless, this is still, I think, the right questions to ask. And there were 2 simulations. One was seeing through, one was not. And I'd point you. There's some language in the in the see-through paragraph that says, that considers situations in which it might be appropriate to see through inflation, and then name some conditions that in which it might not be. In any case, this is not a question that's in front of us right now. We won't face that question. We don't know when we'll face that question. What the committee's doing now is discussing pathways and understanding, again, the ways in which tariff-driven inflation can affect tariffs can affect inflation in the economy, and how to think about that. So we've done a good bit of work. All of us have, each of us has, and it puts us in position when we finally do see what the actual policies are to make a more careful, thoughtful assessment of what might be the appropriate policy response.
Great. And just a quick follow-up. Given the recent bout of inflation that we've been through, with consumers seeing how prices can rise and businesses seeing that they can raise prices at least for some time, does that make it a little bit riskier to look through tariffs? I mean, do you feel you have to respond more quickly to inflation threats, given what we've seen in the past few years?
So the main thing is, and this is also a point in these alternative simulations, is there are just many factors that go into how much tariffs will even go into consumer inflation. How persistent will that be? And so we just don't know really very much at all about the actual policies. So it's very premature to try to make any kind of conclusion. We don't know what will be tariffed from what countries, for how long, in what size. We don't know whether there'll be retaliatory tariffs. We don't know what the transmission of any of that will be into consumer prices. To your point as well, I wouldn't say that we know whether the last episode is or is not a good model for what happened. You pointed out we've just been through a period of high inflation. We've just gotten through that period. That's a difference. There was also quite a bit of diversion of trade away from China to other countries since that may have effects. I don't know. I just think we need to take our time, not rush, and make a very careful assessment, but only when we've actually seen what the policies are and how they're implemented. And we're just not at that stage. We're at the stage of doing what other forecasters are doing, which is kind of thinking about these questions, but not trying to get to definitive answers for some time.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, to make sure I understand, participants today revised up their core PCE inflation projection for 25 so that the central tendency runs from 2.5% to 2.7%. And as Howard noted earlier, most of the committee sees the risks to those projections to the upside. So if inflation only declines next year from 2.8 to 2.5 to 2.7, what would compel the committee to be cutting in that situation?
Let me find these numbers. So we have inflation coming down, core inflation coming down to 2.5 next year. That'd be significant progress. You see a slower path. I think that does take on board that we want to see real progress, but we'd be seeing meaningful progress to get inflation down to that level. That wouldn't be all the way to 2%, but that would be better than this year. This year will be 2.8 or 2.9. That would be meaningful. We also have to think about the labor market, and while we have the labor market forecast as being in good shape, we are also mindful that it is still out there very gradually cooling so far in an orderly, gradual way. But it's also something we need to keep our eye on.
I guess if I could follow up, if somebody looked at these projections and also the insertion of the extent and timing language in the statement, which has been used at times in the past when the committee thinks maybe it's going to be on hold for a while, and they said, gee, this looks like it could be the last rate cut for some time, would they be mistaken to infer that?
So that's not the That's not any decision that we've made at all. Let me explain extent and timing. So the sense of that wording is to make clear that if the economy does evolve about as anticipated, we're at a point at which it would be appropriate to slow the pace of rate cuts. So extent, that just relates to how much further we can reduce our policy rate consistent with getting to a neutral stance. Clearly, that distance has shrunk by 100 basis points. So it's significantly smaller. So that's the extent question. And we're going to be looking for further progress on inflation as well as a strong labor market to make those cuts. Timing just suggests, again, that we're at a place where we assuming the economy develops as expected, we're at or near a level that will make it appropriate to slow the pace of adjustment. So that's what we mean by that. We're not trying to make decisions about the longer run. We're trying to make sensible policy as we go. And, I just would emphasize the uncertainty, which is it's just a function of the fact that we expect significant policy changes. There's nothing really unusual about that. I think we need to see what they are and see what the effects they will have. We'll have a much clearer picture, I think, when that happens.
Mike.
Michael McKee from Bloomberg Radio and Television. Even though you've cut rates by 100 basis points this year, we haven't seen much change in mortgages, auto loan rates, or credit card rates. You say you're significantly restrictive. Are you running a risk that the markets are fighting against you and the economy could be more at risk of a slowdown than you anticipate?
So the rates that you talked about are really longer run rates, and they are affected to some extent by Fed policy, but they're also affected by many other things. And longer rates have actually gone up quite a bit since September, as you well know, and those are the things that drive, for example, mortgage rates more than short-term rates do. So we look at that, but we look at all financial conditions, and then we look at what's happening in the economy. So what we see happening in the economy, again, is, most forecasters have been calling for a slowdown in growth for a very long time, and it keeps not happening. So we're now well into another year of growth that looks like it might be 2.5%. Second and third quarters were right about at the same level. So the U.S. economy is just performing very, very well, substantially better than our global peer group. And there's no reason to think a downturn is any more likely than it usually is. So the outlook is pretty bright for our economy. We have to stay on task, though, and continue to have restrictive policies so that we can get inflation down to 2%. We're also going to be looking out for the labor market. We want to keep the labor market pretty close to where it is. We're pretty close to estimates of the natural rate of unemployment. Job creation is a little below the level that would keep it there, but nonetheless close. And so that's what our policy is trying to achieve.
If I could follow up by asking about your formulation for beginning rate cuts included the phrase, we need to have confidence that inflation is moving down towards our target. Given the fact that you've raised your forecast for next year, do you have confidence or are you uncertain about the path of inflation going forward?
So confidence was our test for raising rates. And, we made, look at the broader sweep. We've made just a great deal of progress. We're well into the twos in core inflation, and around 2.5 or even lower than that we have been for headline inflation. So I would say I'm confident that inflation has come down a great deal, and I'm confident in the story about why it's come down and why that portends well. And I'll tell you why. Again, you do see with housing services inflation, which is one that we've really worried about, it really has come down now quite steadily at a slower pace than we thought 2 years ago, but it's nonetheless steadily coming down as market rents start to equilibrate better with new leases that turn over, not new tenants, but new leases. Market rents is new leases. So that's happening. That process is ongoing pretty much as we expect. Goods inflation, which is another big piece of it, has returned right to the range where it was before the pandemic. Just for some months this year, it kind of moved up in a bumpy way because of used cars and things like that. But we think overall that should generally be in the range it was in. That leaves non-housing services, and market-based non-housing services are in good shape. It's non-market services, and those are services that are imputed rather than measured directly, and they don't. We think they don't really tell us much about the about tightness in the economy. They don't really reflect that. I mean, a good example is financial services, which is really done off of asset prices, and that's how that inflation works. So the overall picture, the story of why inflation should be coming down, is still intact. In particular, the labor market. Look at the labor market. It is cooler by so many measures now, modestly cooler than it was in 2019, a year when inflation was well under 2%. So it's not a source of inflationary pressures. Not to say there aren't regional and particular professions where labor is tight, but overall, you're not getting inflationary impulses of any significance from the labor market. So what's the story? The story is still just we're unwinding from these large shocks that the economy got in 2021 and 22. In, for example, housing services, and now also in insurance in particular, where costs went up, and those are now being reflected later in housing insurance. It's real inflation, but it doesn't portend persistently high inflation. So we and most other forecasters still feel that we're on track to get down to 2%. It might take another year or two from here, but I'm confident that that's the path we're on, and our policy will do everything it can to assure that that is the case.
Colby.
Thank you. Colby Smith with the Financial Times. So the unemployment rate as of November, while still very low, is within spitting distance of the level that generated a lot of concern about the labor market over the summer in the lead up to the 50 basis point cut in September. Hiring has also narrowed to just a handful of sectors. But now the committee appears comfortable skipping cuts at upcoming meetings. So what has changed about the committee's assessment of the risks confronting the labor market? Is there just less concern now on that front, or is it just about there being more upside risk to inflation that now needs to be accounted for?
The unemployment rate is now the same as it was in July, 4.2%. It's moved up and down, but it's now the same as July. Job creation is lower than it has been, but it's been steady. It's not declining. It's steady at a level which, as I pointed out a couple of times, is actually below the level that would hold the unemployment rate constant, but it's not so far below. So you might if we have the break-even level right, and if job creation continues at that level in the establishment survey, then you would get a tenth maybe every other month kind of thing. So gradually declining. We don't have that kind of precision in this. So you're right, though, and I read out some of the reasons. We do think the labor market is still cooling by many measures, and we're watching that closely. It's not cooling in a quick or in a way that really raises concerns. I think, you pointed out, participants in the FOMC really thought that the risks and uncertainty had improved relative to the labor market. And it's because things have just gotten a little bit better. It doesn't, the unemployment rate flat and things like that. Nonetheless, we're watching it closely.
If the idea, though, is that no additional kind of softening in the labor market is welcome here, what's to prevent that from happening if rates are still restrictive? So
what I said is we don't think we need further softening to get to 2% inflation. That's what I'm saying. Not that it's not welcome. We don't need it, we don't think. If you had a situation where inflation's moving around by a tenth every few months, that's, we'd have to weigh that against the fact that inflation has, in recent months, been moving sideways in the 12-month window. And so we've got to weigh them both. And at this point, for a while there, we were only really focused, mainly focused on inflation. We've now gotten to a place where the risks to the two are, we think, are broadly, roughly in balance. And so that's how we think about it.
Steve.
Mr. Chairman, I did not hear you use the word recalibration today. And I'm just wondering if the recalibration phase is over and what you might call this new phase and whether the criteria for changing rates is somehow different and higher than it was before. Thanks.
We're not renaming the phase yet, but we may get around to that. But no, I would say we are, though, in a new phase in the process, as I said. So, and that's just because we've reduced our policy rate by 100 basis points. We're significantly closer to neutral. We still think where we are is meaningfully restrictive. And I think from this point forward, it's appropriate to move cautiously and look for progress on inflation. We've done a lot to support economic activity by cutting 100 basis points, and that's a good thing. I support the decision, and I think it was the right decision to make. I think from now, we are in a place where the risks really are in balance, and we need to see progress on inflation. And that's how we're thinking about it. So it is kind of a new thing. We moved pretty quickly to get to here, and I think going forward, obviously, we're going to be moving slower, which is consistent with the SEP.
I wonder if I could follow up and ask you how much you or the committee are looking through some of the high numbers we've had in the recent inflation numbers. For example, cars being up maybe because of the hurricanes, eggs because of the avian flu, that kind of stuff, and then looking forward perhaps to housing inflation coming down as it did in the recent report.
So we always try to be careful about not throwing out the numbers we don't like. It's just an occupational hazard is to look, those high months are wrong. What about the low months? We have a very low month potentially in November. It's estimated by many to be in the mid-teens for core PCE. So that could be idiosyncratically low. We try to look at not just a couple or 3 months. We shouldn't have our position shouldn't change based on 2 or 3 months of good or bad data. We have a long string now of inflation coming down gradually over time. As I mentioned, 12-month, I think it's 12-month headlines 2.5, 12-month core is 2.8. That's way better than we were. We still have some work to do, though, is how we're looking at it, and we need policy to remain restrictive to get that work done, we think.
Neil.
Thanks, Chair. Thank you, Chair Powell. Neil Irwin from Axios. Financial markets have been very buoyant really all year. Is the committee comfortable with where financial conditions are, or do you see a risk that looseness in financial conditions could undermine progress on your inflation target?
So we do look carefully at financial conditions, of course. That's part of what we do. But, we really look carefully at is the performance of our goal variables and how are we affecting the economy. So what we've seen over the course of, just take the last year, we've seen inflation, over the last couple of years, come down a lot. We've seen the labor market cool off quite a bit. That suggests that our policy is restrictive. We can also look more directly at the parts of the economy that are affected by that are interest sensitive, like particularly housing. Housing activity is very low, and that's partly significantly because of our policy. So we think our policy is working, it's transmitting, and it's having the effects on our goal variables that we would want. A lot of things move financial conditions around, as you know, and we don't really control those. But I'd say we see the effects we're hoping to see on the goal variables and the places where we'd expect to see it.
So if I may, speaking of assets that have been buoyant, do you see any value or benefit in the U.S. government building a reserve of Bitcoin?
We're not allowed to own Bitcoin. The Federal Reserve Act says what we can own, and we're not looking for a law change. That's the kind of thing for Congress to consider, but we are not looking for a law change at the Fed.
Andrew.
Hey, happy holidays, Mr. Chairman. Thanks for taking our questions. I was wondering if you are satisfied with the way 2024 is ending, if you're confident that we've avoided the recession that forecasters were predicting as inevitable a couple years ago.
I think it's pretty clear we've avoided a recession. I think growth this year has been solid. It really has. PDFP, private domestic final purchases, which we think is the best indicator of private demand, is looking to come in around 3% this year. This is a really good number. Again, the U.S. economy has just been remarkable, and it's when in these international meetings that I attend, this has been the story, is that how well the U.S. is doing. And if you look around the world, there's just a lot of slow growth and continued struggle with inflation. So I feel very good about where the economy is and the performance of the economy, and we want to keep that going.
The other thing I just wanted to ask about was the you guys have noted that the unemployment rate is still low. However, employment rates have fallen rather quickly. The prime age employment rate has fell by about 0.5% rather recently. The question, I guess, is do you think there's maybe more downside momentum in the labor market than the unemployment rate alone is signaling?
I don't think so, no. I think overall, if you look at it, prime age participation is still very high. What's going on in the labor market is that the hiring rate is low. So if you have a job, you're doing very well, and layoffs are very low, right? So people are not losing their jobs in large numbers, unusually large numbers. If you are looking for a job, though, the hiring rate is low, and that's a signal of lower demand. It has come down. So we look for signs like that. And that's clearly a sign of softening, further softening. I didn't mention it earlier, but I think you can see an ongoing gradual softening in the labor market. Again, not something we need to see to get 2% inflation. And that's part of the reason that explains why we moved ahead today with the action, with an additional cut. So, but you take a step back, the level of unemployment is very low. Again, participation is high. Wages are at a healthy and ever more sustainable level, wage growth. And so the labor market, this is a good labor market, and we want to keep it that way.
Thanks.
Amira. Thank you, Amara Mokway from Bloomberg News. I just want to put a finer point on the labor market. Can you keep the labor market this way, in the strong position that you have described, without further cuts? In other words, do you still view the labor market as needing support to protect against a further cooling?
We can't know that with any tremendous certainty. I will say that we think that our policy balances the risks. We think the risks are roughly in balance as between the two mandates, and we think the labor market is in solid shape. And when I say it's softening or cooling, it's a very gradual process. Job creations are meaningfully positive. Wages are, if anything, still a bit above what would be sustainable if productivity were to revert to its longer run trend. If you take into account the high productivity readings we've had, then wages are already at a sustainable level relative to 2% inflation. So I don't want to overstate the downside in the labor market, because the downsides clearly appear to have diminished. Nonetheless, it's one of our mandate goals, and we pay close attention to it, and it's worth noting that it is still gradually cooling, gradually and in an orderly way. And that's how I would characterize it, and that's why we're paying careful attention.
Elizabeth.
Thanks so much, Chair Powell. Elizabeth Schulze from ABC News. As you've noted, the Fed is now forecasting higher inflation next year. High prices are still a burden for so many households right now. Why do you think it is that inflation is proving to be more stubborn than you'd expected?
It breaks down into a long answer if you want, but it just has been a little bit more stubborn. I think if you go back 2 or 3 years, many people were saying that to get this far down, we would have had to have had a deep recession and high unemployment by now. Well, that has not been the case. So, the path down has actually been much better than many predicted. We've managed to have the unemployment rate remain essentially at its longer run natural rate, while inflation has come down from, core PCE inflation has come down from 5.6% to 2.8% on a 12-month basis. So that's a pretty good outcome. Why hasn't it come down? One reason is that just a technical issue around the way we calculate housing services, and that process has been slower than market rents are showing up more slowly in that measure than we might have thought 2 years ago. So that's part of it. I think there are other parts of the story, but what I think people are feeling right now is the effect of high prices, not high inflation. So we understand very well that prices went up by a great deal, And people really feel that, and it's prices of food and transportation and heating your home and things like that. So there's tremendous pain in that burst of inflation that was very global. This was everywhere in all the advanced economies at the same time. So now we have inflation itself is way down, but people are still feeling high prices, and that is really what people are feeling. The best we can do for them, and that's who we work for, is to get inflation back down to its target and keep it there, so that people are earning, big real wage increases, so that their wages are going up. Their compensation is going up faster than inflation year upon year upon year, and that's what will restore people's good feeling about the economy. That's what it will take, and that's what we're aiming for.
And as we look ahead to next year, what do you see as the biggest challenge to the economy under the next administration?
I feel very good about where the economy is. Honestly, I'm very optimistic about the economy, and we're in a really good place. Our policy's in a really good place. I expect another good year next year.
Edward.
Thanks, Chair Powell, for doing the questions. Edward Lawrence from Fox Business. So you say that we're closer to the neutral rate. What % do you see and the committee believes, where is that neutral rate?
So I'll say a couple things. First of all, when we write, the thing we write down in the summary of economic projections is the longer run neutral rate, which is the neutral rate at a time when supply and demand are in balance, the full economy is in balance, and no shocks are hitting the economy. That is not where we are right now. So when we're making monetary policy at the Fed, that's not the question we're asking. So you can't do a straight read between those longer run numbers that we write down and what we think the appropriate policy should be. So basically, at any given time, various shocks are hitting the economy. And so what we're doing in real time is we're looking at our policy stance, and we're looking at the way it's hitting the economy. And particularly, we look at the effects it's having as we try to move the economy toward maximum employment and price stability. And the answer can be, there are things that affect the economy that are lasting but not permanent, and the ones that are permanent are the ones that would be in our star. The ones that could be lasting but nonetheless go away over time, they could actually affect what's sort of technically the appropriate neutral stance in near term. So we're looking at that, and we don't know exactly where it is, but as I like to say, we know it by its works. And I think what we know for sure is that we're 100 basis points closer to it right now. There are many estimates of where that might be, and we know we're a lot closer to it. And I think we're in a good place, but I think from here, it's a new phase, and we're going to be, cautious about further cuts.
But I think that the markets are looking for a little more clarity. I mean, I've heard estimates from 2.9% to 4%. I think the markets would like to see a little more clarity about a year out, 18 months out, as to where that goalpost, for lack of a better term, is, because at the moment it looks big.
Yeah, I mean, honestly, there are countless models of what a neutral rate might be at any given time. There are empirical models, there are theoretical models, there are things that combine them, and they have as many different answers as you'd like. So there is no real certainty. And I mean, it's actually a good thing to know that we don't know exactly where it is. So you're not tempted to think, oh, I think this model or this estimate is right. You just have to be open to the empirical data that are coming in, and also how it's affecting the outlook. And it's not made any easier by the fact that that our policy works with long and variable lags. Nonetheless, that is the job we have, and so I think it's appropriate for us now to proceed cautiously, now that we're 100 basis points closer to neutral, and we'll do so. Meanwhile, the economy seems to be in good shape, and these cuts will certainly help to support economic activity and the labor market, while we can still make progress on inflation, because policy is still meaningfully restrictive.
Victoria. Hi, Victoria Guida with Politico. I just wanted to make sure I understood what you were saying at the beginning about inflation. Are you saying that progress on core PCE counts as progress on inflation, even if headline inflation ticks up? And then also, since that's what's projected in the SEP, I was wondering what accounts for that? Why do you all see core PCE going down and potentially headline inflation ticking up?
So, and as I imagine you know, the goal overall is headline inflation because that's what people experience. People don't experience core inflation; they experience inflation, and that includes food and energy costs. So that's the overall goal. But as we know, headline inflation contains energy and food, and those prices can fluctuate for reasons that are not related to tightness in the economy and therefore are not really good predictors of future inflation. So it turns out that core inflation is a better predictor of overall inflation than overall inflation is. So we look at core inflation because it's a better measure of what future inflation is likely to be because it's a better measure of what inflation pressures exist. So it's complicated, but ultimately our goal is headline, not core. So your second question was what?
Why do you all see core going down but headline potentially ticking up?
So headline can be affected. You're talking about next year.
Mm-hmm.
Yeah, so headline can be affected by energy prices and food prices. So that there will be things in the headline forecast that are to do with forecasts of energy prices, whereas core will be, if you look at core going out a full year, then it'll be much more driven by things like tightness in the economy. So that's why the two can go in different directions. Headline has been lower, as you know, most of this year, but that's because energy prices have been coming down, which is a great thing for people, but energy prices will come down and then they will go up, and it won't really be telling us anything about how tight the economy is and how future inflation will perform.
Do geopolitical risks factor in at all to how you're thinking about energy prices?
So we monitor geopolitical risks really quickly, but really carefully rather. But I would say so far those risks nothing has come out of those risks that has really been important for the United States economy. The single thing that you would look to is the price of oil, given that we're talking about the Middle East and Ukraine, but that is a good summary statistic for the kind of thing that could go wrong with global turmoil. But the price of oil has been coming down, and because of global supply conditions. So the U.S. is not feeling really the effects of geopolitical turmoil, but we are certainly at a time of elevated geopolitical turmoil, and it remains a risk.
Kelly.
Thanks, Chair Powell. Kelly O'Grady from CBS News. I want to go back to something that you said a minute ago, that wage growth is outpacing inflation now. It wasn't the case for some time, of course. It's partly why Americans haven't felt much relief in their wallets from prices yet. But with inflation ticking up, how worried are you the progress in closing that gap could go away?
Yeah, so inflation, again, we don't react to a couple of months of higher readings or a couple of months of lower readings. And what we had was we had 4 months of really nice readings, and then September and October were higher, but then November is much lower. So I don't really think the public is experiencing that as a surprising upside risk to inflation. I think inflation is much lower. What the public is feeling, and they're right about it, is that prices are just, the price level went up because of the past inflation, and it's going to take some time for real wages to recover over a period of years in which your real compensation is growing. And in other words, your compensation is growing meaningfully faster than inflation. That's exactly the kind of economy we have now, and we just want to hold on to it. That process will probably take some years, but that's what's going on right now. And I don't think that a couple of months of higher inflation really signal that anything of the nature you're suggesting.
And just one follow-up. Let's look more long-term. You previously predicted hitting the 2% inflation target in 2026. It's now been pushed out to 2027. You said you're focused on enabling further progress on inflation. That's not necessarily progress in the right direction. Are you confident that target isn't going to move further out?
We're talking about when you're projecting the economy, 3 years out, 2 years out, you're talking about high uncertainty, very high uncertainty. We really, at that point, it's not possible to confidently predict where the economy is going to be in 3 years. So what we're doing is we're looking at what's happening now, and we're kind of projecting that the same kinds of things are happening. So we keep a strong labor market. housing services inflation comes down, goods inflation settles down, and non-market services return to their prior level. All of those things should happen over time, and those pieces come together. There's every reason to think that they will. The timing of it is highly uncertain. But you're not wrong though that it's been a bit frustrating because while we've made progress, it has been slower than we had hoped. Nonetheless, we're still on track, and I think if 2 years ago you'd said we were at 4.2% unemployment and 2.8% inflation, people would say, "I'll take that." I mean, that's a pretty good interim place to be. Job's not done, but I think we're feeling good about where we are and where we're headed.
Go to Nancy for the last question.
Hi, Chair Powell, Nancy Marshall-Genzer from Marketplace. You said a couple times inflation has been moving sideways. Appears to be settling in around, 2.5%. Do you think the Fed is just going to have to settle for that and accept that you're not going to get to your 2% target?
No, we're not going to settle for that. I think we certainly have every intention and expectations that we'll get inflation back sustainably to 2%. That is, and I am confident we will achieve that. It has taken longer, but you have to be. We are making progress. We have made a great deal of progress, and we'll continue to do so, and get back to 2% inflation. That's what we owe the public, and we're committed to achieving it.
In that case, can you rule out a rate hike next year?
You don't rule things completely in or out in this world. That doesn't appear to be a likely outcome. I think we're at 4.3%. That's meaningfully restrictive, and I think it's a well-calibrated rate for us to continue to make progress on inflation while keeping a strong labor market. So, thank you very much.
Federal Reserve Chair Jerome Powell just wrapping up his news conference. Investors not reacting well to the news. Major averages selling off on not just the news that we got the rate cut, that was expected, but net now the summary of economic projections is putting the Fed's expectations for rate cuts next year at only 2. And Powell there, Nancy Gensler over Marketplace, getting in a little question there about whether he would rule out a hike next year. And he seemed to say, I don't want to rule out anything because I don't know what's going to happen. Really emphasizing that he believes the economy is on solid footing right now. He was pretty firm on that point, but also really leaving the door open to a wide range of possibilities.
Yeah, strategists' response and reactions are coming to my inbox, Julie, and being described here as a hawkish cut is how some are placed this, meaning, yes, they reduce rates by 25 basis points, but they also, of course, signal less easing in 2025. And to your point, it was interesting to hear Powell talk on the economy, clearly conveying this positive message. He likes what he sees, says we're in a really good space. But on inflation, he was saying, listen, broadly on track, but he said a little bit more stubborn, moving sideways. Now, he was asked toward the end there, would the Fed just simply accept that we're not going to get back to your target? Not surprisingly, Powell saying, no, we're going to get back to 2%. He's confident in that, but he did acknowledge, listen, it has taken longer.
A couple other things to mention from this press conference there. He was asked about fiscal policy, and he said, we don't know what the fiscal policy is going to be, and we don't know what the outcome of the fiscal policy is going to be. That said, interestingly, we know that Beth Hammack dissented today and said she did not want to cut rates. He said some people in the meeting did take a very preliminary step and start to take a look at sort of highly theoretical conditional effects of potential fiscal policy. He said some people did not take that into account, and some people didn't say whether or not they took that into account. So obviously they're at least having the discussions about the potentials for fiscal policy and the effect on inflation and the labor market, even if, they're sort of preparing to take that into account, even if they don't yet know what those effects
he talked about how you kind of tread a bit more carefully, right? I think he's sort of likened it to Julie, to, in the same way you sort of drive on a foggy night,
Yes.
you get a bit more careful. And he's right, because you have tremendous uncertainty around taxes, regulation, tariffs, and immigration. Yeah.
Just want to put a fine point on what we're seeing in stocks, because we are seeing a pretty dramatic sell-off going on in the major averages. The S&P 500 on its worst track for its worst day since October 31st, the Nasdaq since November 15th, and the Dow since September 3rd. And speaking of the Dow, it is now on track for 10 straight sessions of declines, which would be its longest losing streak. Nine was going back to 78. This is going back to 1974 potentially, if it falls for 10 sessions in a row. So right now we've got the perfect person to talk about why this is happening.
We sure do. The Federal Reserve cutting by 25 basis points moments ago. For more Fed reaction, let's bring in now Michael Kantrowitz, Chief Investment Strategist at Piper Sandler. Michael, it is great to see you. Let's get right to the news. Michael, I want to get your reaction to what the Fed did, what Jay Powell just said, and obviously, of course, what do you make of this response we're seeing in the markets, Michael?
Sure. Yeah. Well, the cut was obviously expected and has been priced in for several weeks. The hawkish tone is an extrapolation of what we've been seeing taking place since the Fed actually first cut rates in mid-September, when we also started seeing data, both employment and inflation data, start to surprise to the upside, which we think has been the major reason why rates are moving higher. So I kind of think of this as a bit of a reset from certainly where expectations have been over the last couple of quarters. I would almost describe this as a bit of a light pivot from Powell, certainly from a second derivative. And as we know, markets care about derivatives or rates of change in anything. So I'm not surprised that the market is selling off. We've been seeing the negative impact of higher rates creep into equities, show up in leadership and market breadth now for several weeks. And now it's gotten close to where we thought it would become systemic at around 4.5% on the 10-year. And I think this is a bit of a game changer, at least for the near term here.
Well, but Mike, even if it was a light pivot, wasn't it a broadly expected light pivot? I mean, I can't tell you how many notes I saw today or in the past few days that used the phrase hawkish cut, right? So if that's the case, if everybody was looking for a cut and everybody was looking for a pause after the cut with maybe this kind of language, then why are we seeing the markets react like this?
Yeah, markets have a funny way of kind of talking about things and pricing them in incrementally, but not really fully pricing them in until they're actually realized. We see this all the time with economic data, with earnings, and with Powell and Fed speak. So we weren't quite sure how hawkish or dovish Powell's tone was going to be. And I think the new SEP, and again, this is all compounding 2 months of higher rates and better economic data, which is, really, not too long ago, right in mid-August, we had a growth scare when the unemployment rate first hit 4.3%. So sentiment, outlook, Fed policy expectations have just been whipped around. And I think we're gonna have to get used to this in 2025 with the Fed's data dependency.
Michael, in terms of what the Fed did today and what Jay Powell said today about inflation specifically, broadly on track, he said, but emphasized how it's taken a bit longer. I'm just curious whether you think that the chances of a rate hike next year, what are they, Michael?
I think it's unlikely we'll get a rate hike next year, but I do think it's likely, and this is, I think, the first time we're starting to hear about it, that people are going to increasingly talk about it. First we have to price out any further rate cuts before we start to talk about a hike. But on the way there, and this started kind of in September, when we had a lot more rate cuts priced in compared to what we have now, and now we only have less than 2 rate cuts priced in. We're starting to think about that, where this could go. Again, markets tend to extrapolate. What could change this? Real simple. If you continue to see the unemployment rate slowly go higher as it's been doing for a year, that could put a lid on yields and I think would be bullish for equities.
So this is really interesting, Michael, because the narrative for so long was, as long as the economy is sort of plugging along here, even in the interest rate increasing regime, when it was that stocks could do okay, right? And we heard Jay Powell, he talked about a lot of uncertainty, but one of the things he did not seem to be uncertain about was the solidity of the U.S. economy. So I guess I'm trying to think, but you're saying if things get a little bit worse and rates come down, that could be good for stocks. I guess I'm just trying to sort of process all of this.
Yeah, it goes back to kind of thinking about what the primary issue is for equities. So almost a little more than a year ago, we held on to a bearish call too long with many others in the recession camp, but then changed our view in October of 2023 because it was clearly evident that higher interest rates were the problem for equities when we saw that last, I think it was a 12% correction in stocks. So our message back then was that anything that brings down interest rates and gets the Fed to pivot will be bullish for equities, including higher unemployment. So we're kind of still there in terms of that view. The relationship between interest rates and equities has ebbed and flowed in recent months, but clearly we're back to a pretty negative correlation. So again, the problem of, when you listen to investors, people are not worried about the economy falling off a cliff, but they are worried about higher inflation. And I think 2022's experience created a paradigm shift in investor sentiment, where if I think about most of my career from early 2000s through 2021, pretty much every market sell-off was a function of a growth scare. And think about the recessions or periods during ZIRP. Whereas in the last couple of years, really markets have only gone down because of rising interest rate or inflation fears. And I think that's the new normal, that going forward, market corrections are going to come from higher rates, not slower growth or higher unemployment. And when you look back far enough throughout history, that's actually the more common reason equities go down compared to the last 20 years.
Michael, final question here, and switching gears a bit, but I'm just curious to get your take. Elon Musk, obviously, Musk now being, close ally of Trump, not happy, Michael, about this bill to avert this possible government shutdown. He's calling on lawmakers to strike down the stopgap measure. I'm just wondering, Michael, do you see those headlines, those tweets? Do you think that is causing part of this downdraft we're seeing in today's session as well?
I don't think it's the primary cause. I mean, there's certainly with our policy team in DC, they're certainly extremely busy with all the policy headlines and the Trump transition. So it's definitely on investors' minds. But when we look at the relationship with interest rates and equities, it's clearly the driver there. But again, anytime a risk presents itself, and in this case, I think it's higher interest rates, investors can, in the short term, start to look at the glass a little half empty. Rather than half full, which is kind of in the sentiment up until very recently.
Mike, when you talk about the lessons learned over the past couple of years, one of the things I know that you stopped doing is providing a specific number for targets, for future targets for the S&P 500. That said, when you look at next year, putting all of this together that we've been talking about today, what can you tell me about the trajectory of how you think stocks are going to behave throughout the year?
Sure. So just real quick, the reason I did that is because right now, as we sit here today and for the last year or two, the correlation of equities to the market in the S&P 500 sits at an all-time low of 9%. So stocks are not reflecting what the market's doing. And we all know, one major reason is the Mag 7. So when we think about the last 2 years, the bulk of the upside in equities has come not from earnings improving, but PEs expanding. And I think that's been a function of the market pricing out the risk of higher rates and higher inflation that got priced in 2022. And so we've had these two back-to-back years where equities, especially large caps, have had explosive returns, of course, compounded by the AI Mag 7 trade. But even in small caps, we've seen valuations go from 11 to 17 in the last 2 years. So as we look ahead, when we look at periods in history where multiples are not going up sharply, and I think that's the backdrop we're finally in, equities tend to produce a return around 7%, so a lot less than we've seen in past years. So I think that's a pretty good ballpark number to think about. The earnings expectations for next year are about 13 to 14% for the S&P 500. I think that's a bit too high. So let's say even if we get 10 to 8% earnings growth, the question is, will rates stay high and will PEs continue to kind of ebb a little lower and offset some of that earnings growth, giving us, again, a little less of a number on that. So that's how we're thinking about it for the market. And again, looking at credit spreads that were, as of yesterday, at 20-year lows, that is the fuel for multiple expansion. And I think at this point, we've exhausted that. So, short of just, another massive broad-based speculative bubble being propelled, I think it's going to be challenging for multiples to go higher. And I think the risk next year is that the economy stays okay and data like PMIs move higher and interest rates like the 10-year can maybe even gets closer to the high fours. And we don't have even 2 more rate cuts. And that probably means that, again, earnings will be okay, but the multiple pulls off some of that return for equities.
Yes, and this has been a tale of multiple expansion, as you say. Mike, thank you so much for all your perspective. Really appreciate it.
My pleasure.
The Federal Reserve cutting interest rates by 1/4 point, and Federal Reserve Chair Jay Powell making remarks on proceeding with caution as the central bank considers future rate cuts. Let's get to Yahoo Finance's Jennifer Schomburger, who is there at the Fed with some of the details. Hey, Jen.
Hey, Julie, that's right. Cautious was the word. Fed Chair Jay Powell underscoring that the Fed is looking to slow the pace of rate cuts next year and take a more cautious approach. Take a listen.
Remember that we coupled this decision today with the extent and timing language in the post-meeting statement that signals that we are at or near a point at which it will be appropriate to slow the pace of further adjustments.
Powell says the central bank is significantly closer to the neutral rate and that if the job market remains solid but progress on inflation continues to be slow, then the Fed would have reason to continue with a cautious approach. Powell says there are 4 reasons why the Fed has changed its path forward for next year. 1, the economy is stronger than expected. 2, the unemployment rate is lower. 3, inflation is higher than forecast. And 4, the committee is closer to that neutral rate. To cut rates further from here, Powell says that the central bank will need to see further progress on inflation. He underscored that inflation measured by a 12-month basis has been moving sideways this fall. The Fed appears to see greater risk to inflation relative to the labor side of its mandate, sort of a flip-flop from what we saw from the chairman late summer, early fall. Of course, risks are still balanced as a whole, but the Fed clearly seems to be paying more attention to inflation at this point. Now, Powell also made clear that some members of the Federal Reserve are taking into account policy uncertainty that could come from the next administration under President-elect Donald Trump and how that could factor into setting interest rates. Lastly, Powell said today's decision was a close call, but that he personally supported the rate cut. Back to you.
And Jennifer, looking ahead to 2025, some new voting members, what does that mean for the Fed looking ahead?
Yeah, so we're going to see 4 new voting members. Every year we see members of the regional bank, 4 members of the regional Federal Reserve banks rotate. And next year we will see Goolsbee from Chicago, Collins from Boston, Musalem from St. Louis, and Schmid from Kansas City. If you looked at today's action and what happened, we saw a dissent from Beth Hammack, but there were also 3 other members, so 4 in total, who would have liked to have seen interest rates kept at current levels. So we can sit here and speculate perhaps if some of next year's voters may be included in today's group, because we know that Musalem and Schmid are markedly more hawkish. Collins seems to go with the pack, Goolsbee a bit more dovish, but overall, perhaps we could see a slightly more hawkish Fed next year, just as we're already seeing rate cuts slimmed back to only 2 cuts for next year.
Jennifer Schomburger, thanks so much. Appreciate it. Well, we're counting down to the closing bell on Wall Street as stocks sell off, and we want to take a look at some of the biggest losers on the S&P 500 as we go to break. Notable here is Tesla. As we have been watching, Tesla's been one of the best performers since the election, up some 50% going into today, so it's pulling back. Broadcom has been another recent winner. It is giving up some of its gains. We're going to have much more Fed reaction and market domination next. Breaking news, we are tracking a sharp market sell-off in the wake of the Federal Reserve cutting interest rates by a quarter point as expected, and also changing its summary of economic projections, aka the dot plot, to indicate only 2 interest rate cuts next year. Now, both of these things were broadly in line with market expectations, but as we just talked about with Michael Kantrowitz of Piper Sandler, you know, the markets are a funny thing.
Mm-hmm.
Maybe even if the rhetoric, even if the chatter going into this was that this was going to happen, doesn't mean that the markets necessarily were pricing that in.
Yeah, I thought Kantrowitz's points were really well taken. I mean, what Michael talked about was this was, in his opinion, a pivot, a light pivot from Powell, basically talking about how, listen, the Fed is going to be more cautious with its next moves with the policy rate. As Michael was saying rightfully, higher rates were already playing a role, Julie. You know, we had the Trump bump and we had stalled out a bit. Part of that was higher rates coming into play. Now we have yields surging here. And part of the reason Kantrowitz did call this, in his words, he called this a game changer, at least in the near term, he said.
Yeah, and it's also interesting, some of the other people we heard about even before the press conference, when we heard from Luke Tilley of Wilmington Trust, who raised concerns about the solidity of the employment market right now, the labor market, saying there are signs of weakness and that there is a risk in the Fed not continuing to cut rates. You know, although Jay Powell seems very convinced that the economy is on solid footing, some of the strategists and economists out there are saying, you know, maybe it's not. Although we have underestimated the economic growth over the past couple of years to our peril, they say. Still, you know, they're still raising some concerns.
It was interesting because listening to Jay Powell talk about the economy, positive, optimistic, right? Clearly saying, you know, solid footing, likes where we're at. Those comments on inflation, though, were worth noting, too. Broadly kept emphasizing, yes, you know, solidly on track long term, but clearly also saying, listen, it's taken more time to get back to the target than we might have expected.
And he's also seemed to say we are prepared for what is coming on the fiscal front, no matter what it is. He said, you know, we seem to indicate that they've done some modeling at the Fed, both the individual members and as an organization. What would tariffs mean if they went into effect at what levels? Some of the immigration policy changes, tax policy changes. If all that happens, what does that mean? You know, it doesn't sound like they're going to anticipate those changes, but that they perhaps will be ready for them when they happen. All right, let's get more details on what's going on in the market here as we do see this sharp sell-off in stocks. Yahoo Finance's Jared Blickery standing by with more. Hi, Jared.
Hi there. Some of the worst movements we're seeing in the bond market and the currencies, but we're going to start with the stock market. This is our global map, and you can see on the left all the carnage. We are seeing the Russell 2000, the worst off. That is down 5% now. It just crossed the 5% threshold. Show you that one real quickly. On a year-to-date basis, still holding on to gains of about 9%, but we're seeing a deterioration. The Dow of the 3 majors is the best off, but it's down 2.6%. That is the worst in 3 months. We're seeing the S&P 500 having the worst day since October. It's down about 3%, and the Nasdaq is now down almost 4%. You can see on the year-to-date chart, still in line with the recent trend, has not broken that to the downside, but this is a development that we're going to want to monitor. And I was mentioning the bond market. We are seeing the most hawkish reaction to a Fed meeting in this entire cycle. And you'd have to go back to when the Fed was doing the opposite, when it was raising rates to see a more hawkish reaction. But in the 10-year, we are seeing 11 basis points to the upside. I will show you a year-to-date chart. It has now eclipsed this prior high that we saw post-election. So this presents a problem because for risk markets, especially the international companies, the larger ones, do not like higher rates. They do not like the higher dollar. The fiscal position of the U.S. is in question. The inflationary impacts of tariffs and also immigration on the docket. And let's get to the dollar, because I think we're going to be hearing a lot more about the potential for a dollar wrecking ball. This is a year to date, and we can see that this is clearly the highest period, the highest level on the chart. You'd have to go back 3 years to find a higher level. And so we just broke through this entire long 2-year trading range. And when you do that, you got to think that there's going to be some momentum to the upside. So that's a danger here, because a higher U.S. dollar weighs on risk assets. We can also see this playing out in the futures, where we're seeing gold futures down considerably. That was a 3-year chart. Here's the intraday, down 2.22%. I'll show you the year to date. To be fair, gold still maintaining 26% of return on its gains this year. Silver futures, very similar situation. It's down a little bit more, 3.4%. And even crude oil, which doesn't typically react to these reports, after 2 p.m. it was positive. Now it has switched to negative. And I will close here with Bitcoin. Bitcoin was almost, I think it reached 107, 108,000, and now it is back down to 100,000. And that's a big psychological level right there. We'll see if that level holds in Bitcoin. Guys.
Thank you, Jared. The Fed releasing its latest summary of economic projections. And for more, we're bringing in Yahoo Finance senior reporter Alexandra Canal. Allie.
Hi, Josh. Yes, a summary of economic projections. It's only released once every quarter, which is why investors, they're so keen on seeing what central bank leaders are thinking when it comes to different economic indicators like inflation, the unemployment rate, GDP, and yes, of course, interest rates. So let's start there. Each dot represents a specific FOMC member. And as you can see, over the long term, interest rates are expected to tick lower. However, you see that there's a lot of dispersion since the further we go into the future, the more difficult it is to predict what exactly will happen. But if we zoom in on 2025 alone, we'll see that most FOMC members, they expect 2 interest rate cuts so that the interest rate, the Fed's funds rate, will come down to 3.9%. We see 5 officials seeing more than 50 basis points worth of cuts next year. And then we have this one lone guy up here who thinks that interest rates are going to remain steady, remain where they currently are. Now, if we compare that to the previous September projection, a lot less easing is expected. So back in September, most FOMC members thought we were going to be seeing 4 interest rate cuts in 2025. Obviously, that's up from the 2 that we now expect to come next year. Now, one of the main reasons for that is sticky inflation. We've seen core inflation be incredibly elevated due to sticky costs of shelter, along with core services as well. The Fed projecting that core PCE inflation, it's going to tick up to 2.5% in 2025. That's higher than the September projection of 2.2%. We will eventually reach 2% in 2027, but again, that's a few years down the line. Jerome Powell, during the presser, he said that inflation remains the biggest factor, the biggest hurdle for the Fed to overcome, and it's an important part of its dual mandate, so something that they'll be keeping a very close eye on. The other part of the dual mandate is the unemployment rate. Now, that's expected to tick slightly higher to 4.3%. That's a little less from September, and then we are expected to remain at that level over the next few years. Longer run, though, 4.2% is what the Fed is projecting. And then finally, GDP, that's been incredibly strong this year. It is supposed to have a deceleration in 2025 to 2.1%. We will eventually hit 1.9% in 2027. But again, Jerome Powell in that presser was saying that the economy has remained incredibly resilient. Of course, there are a lot of risks next year with the incoming Trump administration, but all things that the central bank said that they can handle. Back to you guys.
Thank you, Allie. Option traders eyeing volatility may want to proceed with caution. Our next guest saying the volatility index has reached an inflection point. Eric Metz, Spider Rock Advisors President and CIO, joins us now to discuss in the Options Pit, sponsored by Tasty Trade. Eric, it's great to see you. I want to start, Eric. Listen, you've been watching the markets a long time. Let me get your take on what you heard the Fed do and say today with the Dow tumbling about 1,000 points here, Eric.
Well, listen, I appreciate the invite here. The inflection point may have been this morning, looking post-election, just at volatility being suppressed and almost becoming too complacent. This spike in volatility today is not a surprise given the information that was just outlined. But more importantly, volatility just tends to be mean reverting, right? And so VIX coming, call it from 14 to roughly 20 as we speak. That's a long-term, average, somewhere between 18 and 22. So again, every time we speak to clients, it's we should expect this. We should expect this multiple times a year.
So what caused the inflection point in the VIX, Eric?
Sure. I just think, post-election, there was a lot of heightened scrutiny around where markets would go post-election. And so once the markets got that clarity and it was all coast is clear for risk assets, specifically in equities. You saw obviously in the crypto space as well, but largely speaking, when volatility came in and a couple days ago, maybe a week ago, it was one of the cheapest points in time to hedge equity portfolios over the past 3 to 4 years. And so when we think about that complacency, it's usually mean reverting, and today's information obviously spooked investors.
With today's information, Eric, did it change how you want to be positioned right now in the market?
I'm not necessarily sure I would get too affected by today's information. There is, a tendency for markets to get too frothy, and I think this retracement, in some arguments, is healthy. So I wouldn't necessarily change course, but it's poised to be data dependent, based upon inflation, unemployment, and things the Feds are watching in their dual mandate. But largely speaking, I would not necessarily change course or call an audible. But risk management is inherently needed.
So what would be sort of your preferred options trade right now in this market, Eric?
Yeah, well, before today, the shorter end of the curve was relatively cheap on an annual basis, over the last 3 years, 5 years, et cetera. Obviously, it's spiked up a little bit now. But given the recent gains, if you look this year alone, with rates flat to mildly up across the board, both 2-year, 10-year, and given equity, appreciation, there's a lot of gains to protect. So thinking about protecting equity portfolios in the light of what tax frictions you could incur, there's just a lot of opportunity to be prudent and solve for portfolio construction here with equities having rallied as much as they have this year.
I'm curious, Eric, when you're talking to your clients right now, what is top of mind for them?
Obviously, the Mag 7 trade, got a jolt in the last week and a half. It looked like it may have been tampering down, but those are still the largest performing stocks over the last 2 years, 3 years, 4 years. And so they're just eyesores. It's a good problem to have, but it is a problem to address just how much excess exposure you have to that sector and to those names specifically. And so when we're dealing with clients, it's thinking about where they're exposed and where they want to be exposed. And if options and prudent risk management can aid that, then that's our job.
Eric, thanks a lot. Appreciate it.
Of course. Thank you, guys.
We continue to track the market sell-off here. So let's take another look at markets as we wind down to the closing bell. We are seeing things back off a little bit from the very worst levels that we were seeing here. Right now, the Nasdaq, which has been leading declines, off 2.8%, the S&P off 2.3%, and the Dow off 2.1%. And really what seems to be happening is stocks seem to be taking their cue from the bond market. We are seeing a big move in the 10-year here today, the biggest that we've seen in some time. And really, the move in the bond market over the past, call it, 8 sessions or so, has been pretty substantial as well. This comes back to something Michael Kantrowitz was talking about, which is that we are still seeing a market that is sensitive to higher rates. And what we learned today is that the Fed is going to indeed keep rates higher for longer, it looks like. So that might be something that is difficult for stocks to digest.
The move in yields, just to reiterate, you talked about the 10-year. If you also look, Julie, just look at that policy-sensitive 2-year. It's surging here. We're up about 10 basis points. We're back to 4.34. And as Michael Kantrowitz was talking to us about, we had already kind of stalled a bit after that big bump, because higher yields, as he pointed out, were creeping in, and now this is just adding more a headwind to that, more of a challenge.
Yeah, it is a pretty broad-based sell-off that we're seeing, though. All of the industry groups are down in the S&P 500. There you're taking a look at yields bump up across the board. I will say the S&P equal weight index is down a lot, is down less, I believe, although I have to check that again. But basically, we've been seeing this lack of breadth happen over the past several weeks, as we had really seen the Magnificent Seven come back to the fore, and we'll have to see what happens now that we are seeing this sell-off that's happening today.
While we are wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. We are tracking the sell-off. Stay tuned for market domination overtime.
There's the closing bell on Wall Street, and now it's market domination overtime, sponsored by Tasty Trade. Let's start with the major averages. Maybe the bulls happy to put this day behind them, guys, because we are seeing a sharp sell-off here. We have now made 10 sessions in a row for the Dow Jones Industrial Average to be lower. We have not seen a losing streak like that since 1974. So a bad result there, obviously, again, if you're a bull in this market. Off here by more than 1,100 points, 2.4% on the Dow. The S&P 500 off by 3% here, and the Nasdaq Composite off by 3.5%. Now, we were talking earlier about the breadth of this sell-off that we are seeing today, because recently we've seen stocks really held up by the Magnificent Seven once again. Well, today it's everybody, right? The S&P Equal Weight Index is down roughly in line, call it, with the S&P 500. The Russell 2000, though, we are definitely seeing more selling, more acute selling happening to that interest rate sensitive group. The Russell off by 5%. All of this, as we heard from Jay Powell in the Federal Reserve, where we are getting that decrease in the number of rate cuts next year. Let's dig more into the action now with our Jared Blickery.
Thank you, Julie. I'm going to go to the VIX here. We're seeing, and by the way, most of these market moves we're seeing today are the most or the least, the best or the worst that we've seen in months, and really erring on the worst side. Here's the VIX. It is up 7.62 points today to 23.49. And as the previous guest was mentioning, that's not super high relative to historical standards, but it is right there at an important potential inflection point. We can see this was a big spike for Yen-Mageddon way back in August. Moving on, we got to check out the bond market, because the bond market yields have been heading higher. Yields are at multi-month highs right now. We exceeded the election high. And then in the dollar, we are at multi-year highs. And that's an issue. We talk about the dollar wrecking ball sometimes as it relates to risk assets. I think we're going to see a lot more of that next year. But in the meantime, let's skip over to the sector action, where we are seeing consumer discretionary having the worst day in over a year. That's XLY. And let me just throw a 3-year chart up there. And you can see, in fact, let me put this on a year-to-date basis. The trend is still up, clearly, but this is a sizable move, which you can really see on the 1-month chart there to the downside. And we're seeing a similar move in real estate. That's about 4%. Tech, 3% to the downside. In financials, 3% to the downside. These have been some of the best performing sectors, except for real estate, since the election. And let's just put that on real quickly. And you can see, those are basically the best performing sectors since the election. And then if we go to our leaders, and I'm going to put the intraday back on, you can just see a sea of red there. Art components, that is a Tesla story, but in addition to Tesla, just about everything else in there in the red. And let's just put up a Tesla chart. That has been surging to record highs very recently. Here is a year to date. You can see Elon's company still holding on to gains of 77%, and that just looks like a little blip there. But I think we're going to see potentially more of this in the days and weeks to come if we see that continuation move higher in the dollar and rates, and that's going to be where the focus is on. Josh?
Thank you, Jared. Federal Reserve's move to cut rates, but also lower the expected number of cuts next year, weighing on the market. The Dow extending its losing streak to 10 straight days. The selling starting as soon as the Fed decision was announced. And joining us now is Tim Urbanowitz, Innovator ETF's Chief Investment Strategist. Tim, it is great to see you on set.
Great to be with you, Josh.
So the Fed gives you the cut, right, that was priced in. They also, though, signal fewer cuts are coming that was previously expected. This reaction, Tim, stocks plunging, yields surging, make sense of it for us.
Well, Josh, I think it's really what investors need to be paying attention to all next year, which is there is such high expectations across the board, right? The expectation for the Fed that they're going to continue on this aggressive pace of cutting without any economic pain. It's great if it plays out, but today, as you see those expectations pulled back, you see the market pull back. And it's more extreme because we've seen so much good news priced in. You know, when we look at the market trading at 22 times next year's earnings, there's a lot of good news that has gone into that. And any piece of information, like the Fed today, that goes against that narrative, it's going to hit valuations, which in turn is going to take a big hit to stocks.
But if the economy is as strong as Powell is saying, and that's why they're not cutting, then what's the problem?
I think the big fear is a reacceleration in inflation. I don't understand why the Fed cut today. I really don't. I mean, you have an economy in good shape.
But that fear is at this point based on what? Because it's not necessarily in the numbers yet.
I think it is. If you look at core CPI is exactly where it is today, where it was back in June.
But that's not
So
a reacceleration.
it's
That's just a
sticky.
stalling.
But I think they're getting nervous about the new administration coming in. You look at different policies.
So you think it could be fiscal policy?
I
that
do think the
accelerates it?
pro-growth policies coming out of Washington. There's fear of that. The tariff piece of the equation, the immigration piece. You start deporting mass immigration, deportation of immigrants. What that does to the labor market, it's got to put pressure on wages, which in turn, puts pressure on inflation. So I think that is something investors need to be very focused on next year and not just become complacent. And we're seeing that stickiness in my view right now.
Did what the Fed did and said today, Tim, did that change at all how you want to be positioned in the market?
I think it doesn't change our stance, and our stance really over the last couple of years is investors need to be very cautious on their expectations for the Fed. We've seen them really be completely wrong over the last 2 years, underestimating how quick and how many hikes were going to be coming, and now just overestimating how quickly and how many cuts are going to be coming. And really, we think right now what is incredibly important is anything in your portfolio, you have to disconnect risk management from the need for interest rates coming down. We see interest rates and inflation as the number one threat to equities. What can rain on this party? We think higher interest rates can. So investors need to really disconnect the need for risk management and interest rates in their portfolio in 2025.
Where do you think that inflation is going to come from if it does reaccelerate?
I think just probably following the same playbook that you saw to kick things off. Goods maybe starting to reaccelerate, services as well. You don't know, but again, inflation is a pretty simple equation at the end of the day. It's supply and demand. The more people that are chasing the same goods and services, the more those are going to be going higher. So specifically when we look at the labor market, again, we see it as very strong. You start taking supply out with the immigration piece of the equation. You add the tariff piece back in. What does that do? I think it's hard to make a case that you're going to see inflation just drop back down to 2%.
Well, Tim, you look now, so the election's behind us. Last Fed decision of the year is behind us. As you look forward, what's the next potential catalyst for the market?
Well, I think one of our themes for 2025 that we've seen is this animal spirits just awakening and driving markets higher. It's really been an optimism-driven market. You look at the gains in the S&P 500 this year, about 60% of those gains have been driven by valuations simply expanding. We think that optimism can potentially continue, right? So that could continue to drive markets higher. But I think on the downside, what could really, like we saw today, what could stop the party is a lot of this good news hinting that it's not going to come through. And I think the next piece of this, Josh, really could be on the fiscal side of things. A lot of the proposals that the Trump administration has put out there, mainly tax cuts, you start to see those not going through or starting to get held up in Congress. That's another reaction that I wouldn't anticipate seeing something similar to what we saw today.
Well, and even with the fiscal policy, even before Trump gets into office, right now we are watching questions about whether the government is going to shut down or not on Friday. It looked like the Congress had a bill in place. Now there's some reporting out there that Trump might be against that. Elon Musk has made noises about being against that. How concerned? I mean, maybe that just gives us a little hint.
Well, I think that's something that is incredibly important. You start to see some disconnect here, right, where you aren't able to get these funding bills through. That is probably the biggest risk to the markets.
In the short term.
In the short term and in the long term, too. You stop getting those deals funded, that creates very big issues. So certainly something we want to be paying attention to. And that puts, that question of, when is all of a sudden the national debt going to become an issue? That puts that right back into play.
I'm looking at just on the screen. There's lots of red everywhere, Tim. The small caps, though, really took it on the chin. Russell 2000, that dropped more than 4%. How do you think about small caps from here?
Well, I think we think there's going to be a tug of war really all year long for small caps to see if they're going to go up or they're going to go down. And one of the things we've seen really all year is you've had these head fakes, right? Peak CPI, you had a run up. Fed starts cutting, you had a run up. They pause, you have a run up. And all of those have fizzled out. We think you're going to continue to see that back and forth. But some of the things that give us a little bit of optimism here is you're starting to see PMIs tick up, which is important. That they tend to follow in lockstep with PMIs, and then you're also seeing small business optimism increase. And I think you look at the beneficiaries of the Trump's proposal of reduced regulation. Small caps are front and center in that. But that doesn't mean there's not going to be some bumps along the way. And I think today, with the interest rate piece, you saw a big speed bump. Small caps, I didn't see where they finished down, but it was a pretty big move.
Yeah.
Significant move down. So it's not going to be a pretty ride. I think there's going to be a heck of a lot of volatility within the small cap space, but ultimately we're cautiously optimistic.
Tim, thanks for coming in. Good to see you.
Good to see you, Julie.
We've got Micron earnings that just crossed, and the shares down a quick 9.7% here. It has to do in part with the company's fiscal second quarter forecast here. Second quarter adjusted revenue of at most $8.1 billion. The street had been closer to $9 billion. And the company says its fiscal second quarter bit shipment outlook weaker than expected. Now, Micron, primarily a memory chip maker, but it has been getting more into high bandwidth memory, so linked to the whole AI food chain here. So there was optimism that the company would do well on the back of that. If you look at the first quarter numbers, again, it's on a different fiscal calendar. First quarter earnings per share, $1.79. That's 3 cents ahead of estimates. Revenue at $8.71 billion, just in line with estimates. But again, the company's second quarter forecast falling short. Micron does say it will return to growth in the second half of the year.
Yeah, so Micron's, those memory technologies show up in a lot of different end markets. Heading into this print, there were analysts who were calling out what they saw as potential pockets of softness, specifically with consumer applications, Julie, and it looks like CEO Sanjay Mehrotra in the statement here is calling that out because he does say, listen, we delivered a record quarter. Our data center revenue, he talks about that surpassed 50% of our total revenue for the first time, but he does emphasize consumer-oriented markets are weaker in the near term. Now, he does add we anticipate a return to growth in the second half of our fiscal year, but that perhaps explains some of the downdraft here.
Yeah, perhaps so. Looking at some of the analyst commentary going into Micron numbers, over at Raymond James, they talked there about growth in high bandwidth memory being, quote, arguably the best secular story the industry has ever seen, but the linearity of the ramp up in that demand difficult to predict. And indeed, this shows kind of that lumpiness, if you will, in the demand. The fact that the company is giving this second quarter forecast, but then saying the second half of the year should be a bit stronger.
Yeah, Sanjay Mehrotra on that point, Julie, adding, in his words, we are exceptionally well positioned to leverage AI-driven growth to create substantial value for all stakeholders. Initially, of course, though investors were disappointed by the print. We'll see what happens on the call.
Yeah.
Meanwhile, Elon Musk and Vivek Ramaswamy are campaigning to get Republican lawmakers to block the stopgap funding bill. And Yahoo Finance's Ben Werschel joins us now with more. Ben, what can you tell us?
Yeah, hey, Josh, it's a quick moving story here. So just in the last couple of minutes, it appears that this bill is on life support at best. Fox News is reporting that President-elect Donald Trump is, quote, totally against the bill. This is a 1,500-page bill that would avert a government shutdown on Friday to next March, and then a whole bunch of other provisions. And those other provisions are what were really at tension here. It was released last night, and it's kind of gone over like a lead balloon amongst Republicans. Elon Musk has been one of the leaders against it, as you mentioned. He has been sort of posting all day against it. He most notably said that any Republican that voted for it should be out of office in 2 years, which clearly he has the means to primary folks. And in just a couple minutes ago, he tweeted that this bill is, quote, dead. We don't have official word that it's over. House Republican leaders are huddling right now, I gather, on this to sort of figure out their next steps. And there's a couple scenarios here. One is they just try to ram it through. Democrats are going to vote for this, presumably. So there's a chance the bill gets passed. The other scenario I'm hearing about is kind of what's called in Washington parlance a clean CR, which is a much shorter bill that simply extends the government. It doesn't do all these other things. That would make a lot of Republicans and Democrats unhappy that their kind of pet projects are gone, but it may be the only way to avert a shutdown on Friday.
Well, and Ben, okay, I obviously there's a lot I don't understand about the way Washington works. If they don't pass this bill, does it save the government money? Because don't they, presumably won't they eventually pass it and then spend the money anyway? Like, how does that work?
Yeah, that's another element of what Musk is talking about today. His position formally is that no bill should be passed at all and that the government should just shut down for 30 days. As if that's a painless process. That definitely would not be painless. There'd be economic cost to that would build. Oftentimes, as you noted, it does it equalizes in the end. The 30 days of a government's closed, it's double when it's open again, so it kind of washes out in the end. But yeah, so this is kind of a very much a self-inflicted wound that would have some economic consequences if there was a shutdown. But they're still sort of in the kind of brinkmanship phase of how much are they going to go here, because it's really complicated. A lot of these provisions that would go away on this clean CR is farm money that a lot of Republicans really care about. So it's a very fast-moving situation for sure.
And Ben, switching gears here, we of course also heard from the Fed today, Fed Chair Powell, not only providing insights into the central bank's rate cut decision today, but also pointing to the Fed's thinking, Ben, about life under a new Trump administration. Any takeaways from Powell's comments today?
There was one moment in particular that I'm writing about for Yahoo Finance this afternoon that I thought was pretty emblematic. He was asked about the 2018 Teal book study of tariffs. So it was a tariff from about 6 years ago on tariffs. Not only did Powell know exactly what was in it, he had it with him, he indicated. So he had this study with him, which was a study under Trump 1.0 about tariffs, the effects of them, whether it's possible to, quote, look through tariffs. So it's basically what the impact on monetary policy could be from tariffs. He's clearly top of mind for him, and it's sort of emblematic of him trying to thread this needle of, as you guys have been talking about all day, make monetary policy based on what he knows now, but kind of be ready for Trump policies once he knows more about what they are. He talked also in the press conference about he's looking at tariffs. His colleagues are looking at tariffs, but they don't know what the tariffs are going to be, exactly how their effects are going to be. So they kind of have to be ready, but not changing policy yet. But clearly having that printout with him today shows that he's getting ready.
Ben, great to see you and have you on the show. Thank you.
Good to talk to you.
Stick around, much more market domination overtime still to come.
tensions are escalating in the U.S. and China chip war. The latest chapter, the U.S. reportedly weighing a ban on a Chinese-made router that is in millions of American homes. For a broader chip outlook going into 2025, we're bringing in Riva Goujon, Rhodium Group Director. Riva, so the latest here, this report that the authorities are looking into this router, is this just sort of the latest step in what is going to be a ratcheting up trade war between the two countries that sort of shows no signs of cooling down?
It's one element of it. You've seen things like the Routers Act. You've seen things like commerce, ICTS controls that really all aim at purging critical infrastructure of Chinese components. This is over data security concerns, cybersecurity concerns as well. And so a number of companies like TP-Link, which is the subject of this investigation, are pervasive in U.S. infrastructure. And this is, again, just one layer of a very thick stack of technology controls targeting China.
Yeah, I guess a broader question is China obviously would like to be this global tech powerhouse. The U.S. government would prefer they not be, and so we impose these export controls to try to stymie those ambitions. I'm just curious, Riva, when you look at those export controls, how really effective are they, in your opinion, as a policy tool?
So on December 2nd, Commerce, the Bureau of Industry and Security, released its third big package of chip controls targeting China. And it is extremely complex. It has a lot of very interesting features, to include a number of extraterritorial provisions, which all together aim to throttle Chinese production in advanced chips. So, for example, you remember the foreign direct product rule, which was used to target Huawei. There are new entity listings that really focus on this Huawei SMIC nexus. SMIC is China's main foundry for producing chips. And so what the U.S. is doing is it's saying that, look, there are a number of tool makers out there that still want to feed into the Chinese chip market. But by introducing provisions to include one that I call single chip de minimis, which is basically, if any covered tool is made in any factory anywhere in the world, and if that factory has a single U.S. chip in it, U.S. will be able to assert its writ and restrict that tool, which is extraordinary because it puts it to other countries now to align with those U.S. restrictions, or they'll be subject to these extraterritorial provisions. So the U.S. is basically telling partners, do the right thing, align with us, or else you're going to be subject to U.S. law and compliance. That's a big deal. It's a very big deal for close allies like Japan, Netherlands, but also Germany, Korea, who have not aligned with U.S. export controls. But still, a very big question of, will it work? Does it actually slow Chinese production in a significant way? Or does it actually accelerate the indigenization of Chinese chip production led by Huawei and SMIC? And if there remain big gaps in partner alignment, I think this will then lead the U.S. down the path of blunter controls. That includes things like blocking sanctions on Huawei, which would have very big ripple effects.
And what's your best guess at the answer to the question you just asked about whether it will just accelerate the sort of growth of their own industries that are being targeted?
So the controls are fairly comprehensive. They are trying to plug in a lot of gaps when it comes to semiconductor manufacturing tools, also to cover new choke points like high bandwidth memory chips. There's another pending rule that's going to focus on clamping down on foreign foundries like TSMC and any advanced chips that they send to China. So there's a lot of things in motion here. The issue is that China has been able to stockpile an enormous amount of equipment, especially over the past 1.5 years. They've been squeezing everything they can out of that equipment. And so it may take a while to even see the effects of export controls biting. That's not even to mention the fact that we have a new U.S. administration coming in, and there's a question mark over whether they take this playbook and run with it, or do they make some big adaptations to it? Do they not enforce it to the same level, to the same technical degree? All of those questions are swirling around it. So again, if we continue to see China making significant progress in advanced node chip production, to include AI chips that rival some of NVIDIA chips, then I think you'll see that movement toward blender controls.
Reva, how effective are the Chinese also in simply getting around these export controls? You talked about stockpiling, but there was this great piece in the Journal, I don't know if you saw it, which also talked about how there was in fact this entire underground network sneaking NVIDIA chips into China. What can you tell us about that?
Well, so of course, smuggling is always going to be a feature of any sanctions regime. There's a question of just how much you're able to smuggle in terms of quantity and the overall effect of that. But there's also a very interesting case of subterfuge that has come to light where Huawei had a shell company that it was using to get TSMC to fab advanced chips for a period of time. And this was a very serious breach. And so this is one of the gaps that the pending BIS rule is looking to plug. But that's revealing too, right? Because if SMIC, China's main foundry, isn't able to produce at the same efficiency as a TSMC to produce very, very complicated chips, and Huawei's relying on shell companies to get TSMC to do the job, that's also in some way revealing of China's challenges as well when it comes to indigenous production. So still a lot of questions of how all these sort of bootstrap methods are going to help China in the longer run, especially as you see the U.S. turning back toward entity listings wrapped with extraterritorial measures to try and short circuit their growth.
Reva, great to have you on the show today. Thank you so much for joining us. Appreciate it.
Thank you.
Time now for what to watch. Thursday, December 19th, sponsored by Tasty Trade. To start off on the earnings front, we're going to be getting another big batch of earnings tomorrow, including Nike, FedEx, and Accenture. Nike announcing results for its second quarter after the close. Analysts expecting that company's quarterly sales to dip, and investors will be listening for commentary from Nike's new CEO, that's Elliott Hill, as well as early reads from holiday sales.
Moving over to housing, monthly existing home sales data for November coming out in the morning. Economists there forecast that number will increase to 4.09 million, and it'll provide more insight into what has been a sluggish housing market.
And speaking of housing, we're going to be getting weekly mortgage rate data from Freddie Mac in the afternoon. 30-year fix fell to 6.6% last week, marking 3 straight weeks of declines.
And finally, we're wrapping up award season here at Yahoo Finance. Keep an eye out tomorrow. We will be unveiling our coveted Comeback of the Year award. Awards so far include our Company of the Year, which was Walmart, Surprise of the Year, General Motors, and Product of the Year, Blackwell, made my own video, of course. Tomorrow's announcement will be our last award of the year. You don't want to miss that.
And that is going to do it for today's Market Domination Overtime. On the other side of the break, it's asking for a trend. I've got you covered for the next half hour with the latest and greatest market-moving stories, so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Ask You for a Trend. I'm Josh Lipton. Stocks were clobbered Wednesday after the Federal Reserve signaled it would cut fewer times next year than previously projected. And here with the trading day takeaways is Yahoo Finance's Josh Schaefer. Josh.
Yeah, Josh, just a rough day in markets. So we saw stocks were actually up before Fed Chair Powell started speaking, before that decision was out, up marginally. And the losses just accelerated as he started talking, right? So here was kind of the key takeaway from the Fed's press conference today. Of course, they cut interest rates by 25 basis points, but this is their dot plot for next year, their projections for where policy is likely to head. And let's take a look at 2025, Josh. You had your median down here before looking at 3 or 4 cuts. Now the Fed's looking at 2 cuts next year. And the market just did not like that answer today. So markets had sort of expected 2 cuts. There was a little bit of teetering over the last month between 2 or 3 cuts. But I think a lot of it had to do with Jerome Powell's messaging throughout the press conference about the overall uncertainty headed into next year. He mentioned some officials have started accounting for the Trump administration's policy, right? But not all officials. And maybe there's a question there, well, once all officials start considering it.
And how did he talk about the uncertainty? It involved the fog.
So there's driving in the fog, which most of us would argue is hard, right? And then he also said...
You get a little bit more cautious, was his point?
A little bit more cautious, right? And be careful. He also said it's like walking through a dark room that's full of a lot of furniture. You might bump your knee, Josh. And so they need to be a little bit more careful, right? Well, here's how markets took that. I mean, look at the Dow Jones, down over 2.5%, the Nasdaq falling 3.5%. And Josh, the thing to remember when you're watching one of these trades where you're seeing something like the 10-year interest rate, the 10-year yield move higher. So here's our 10-year up close to 4.5% for the first time since May. What usually moves on something like that? An area like small caps, Josh. So let's take a look at the Russell 2000. Off almost 4.5%.
Yeah.
Why is the Russell 2000 off so much today? Well, part of the reason that the Russell 2000 is off so much today, those companies are more exposed to short-term interest rates, to floating interest rates. They're more exposed, more likely to come back to market and need to borrow at the currently high interest rate, right? Companies in the S&P 500 are not as exposed to those interest rates. So this has been an interest rate sensitive play, basically fully unwound today, Josh. We go to a 2-month. It had been one of the Trump trades post-election. Take a look at it over the last 2 months, basically all undone. So we're seeing quite a bit of that. Basically, as we had been pricing in higher rates over the last 2 or 3 weeks, areas like this, you could see it started to slip. Today, it confirms the news, full sell-off.
We spoke to Michael Kantrowitz from Piper on the show today, and I liked how Michael put it, which is, he kind of framed it like this, Josh. He said what you saw from Jay Powell today was a pivot, a light pivot. And just in terms of the Fed saying, listen, we're going to be more cautious when making moves with our policy rate. And higher yields they were creeping into the conversation. And today, of course, yields just surged. Kantrowitz described it as a game changer, at least in the near term.
And we know Kantrowitz always has great commentary, Josh, I think, about the 10-year. So I think it's an interesting thing to highlight as far as trends go and what to watch, right? The area that he often highlights, the level he often highlights is 4.5. So we're almost there. And a lot of what Kantrowitz often says is once we get above 4.5, you're going to see this bias toward probably large caps, right? Companies with healthy balance sheets, kind of the trade we've been seeing over the last 2 weeks. Didn't play out today. The Mag 7 did not do well, but I think it will be interesting to see if that continues as we move forward, as we're looking at this, right? So as we've gotten above 4.5 before, what's this? This is April, right? What happened in April? That was one of the 5% drawdowns that we had this year, right? Stocks fell pretty significantly. And so that will be an interesting level to watch as rates continue to rise. Do we see an impact of that? Another thing I'll flip to here, Josh, just because I mentioned them and I want to take a look at them. The Magnificent Seven did not have a good day. And one interesting one for you, the stock that had been rallying a lot over the last month got particularly hit today. Tesla down over 8%, perhaps just investors taking a little bit of enthusiasm out of the market that had clearly been priced in over the last couple of weeks.
And now, Josh, you said, so elections, rearview mirror, the final Fed decision of the year, rearview mirror. I mean, what if you're an investor, what are you looking for? What's the next potential catalyst? Are you already looking ahead, to earnings season?
Yeah, I mean, it seems like maybe earnings season come January, right? Maybe it's just, okay, we now know the Fed's median projection is for 2 interest rate cuts next year. They see higher inflation. What's my trade-off of that? I don't think that necessarily means that all 11 sectors are going to fall every day for the next week, right? I think it's, okay, markets just sold off. You can see a defensive bias here. You're looking at staples and healthcare and utilities leading. now where do I go? Where can I hide, as we've said, as interest rates get higher as an inflation trade? I think you're going to see that start to work through the market, Josh. And the other thing we have is, you still have a jobs report coming in 2 weeks, right? You have another Fed meeting coming in January. And of course, you have Donald Trump coming into the White House on January 20th. I think a large takeaway from Powell's speech today, they also, not just investors, the Fed wants to know what he's going to do and get a little bit more policy clarity, and perhaps we'll start to get that.
They're guessing like everybody else.
Right.
All right. Thank you, Joshua. Meanwhile, housing starts fell in November to the lowest rate since July, pressured by a drop in multifamily projects. And joining us now with more is Yahoo Finance's Danny Romero. Danny.
Josh, home builders are pulling back on multifamily housing construction. The latest government data that came out today really showcases that multifamily housing starts fell 23% in November, but single-family home construction saw the biggest gain last month. Overall, housing starts fell 1.8% from the previous month to an annualized pace of 1.29 million, as you can see on your screen. Remember, builders over the past year have been ramping up construction, taking advantage of the lack of housing that has been happening on the existing home sales front. The outlook for builders, though, looks a little cloudy right now. Builders have been working through these projects, but at a slower pace. If we take a look at the number of projects under construction, that nearly fell 2%. That is the lowest pace in more than 3 months. But what's interesting of all of this is that inventory of new homes for sale hit a 17-year high. So the big question here is, what's going to happen for the new home market looking ahead?
And when you talk to pros, what do they tell you?
Well, I think it's a debate, right? Like you were talking with Josh earlier, of there's this kind of cautious optimism outlook right now. I mean, really it comes down to rates. That's really been the impact here on the housing front, and for builders as well. It does cost them to build right now, and so that is a factor, and they're going to be looking ahead about what the new administration will be doing to impact all of that.
All right, we all will. Thank you, Danny. Appreciate it. Joining me now to help understand where the housing market could be headed in 2025 is Mark Palem, Fannie Mae Chief Economist. Mark, it is great to see you. So, I want to start with the Fed today, Mark, because listen, the Fed came out, they gave you the cut many expected. They also signaled, though, Mark, fewer cuts are coming next year than previously expected. I'm curious what you make of that decision. What does it mean for the American housing market in 2025?
Yeah, so the key issue for the housing market in the United States for sure has been affordability, of which high mortgage rates is definitely part of that discussion. And it's also been renter affordability. So the Fed today came out and ratified investor concerns, so bond market investor concerns about whether inflation is stickier than it looked 6 months ago, or that it even looked at the beginning of the year. So you should expect mortgage rates to, remain a little higher than it might have otherwise been, and that's a headwind for the housing market. I will note from your last segment, it was very interesting to hear the discussion about new home sales in the new home market. That's one place where the new home sales market has actually been a pressure valve for households. They've been able to, the price premium of a new home to existing homes is at a very low level, only about 4%. And so that's really helped people to be able to find a home they can afford.
So it's interesting, Mark, just sticking with that issue of affordability. I'm looking here on Mortgage News Daily. They tell me the 30-year fixed, we're back to 7.13, Mark. I'm curious, what is that going to mean for existing home sales in 2025? What are you modeling? What are you forecasting?
Yeah, so it's really been a tug of war this year between the lock-in effect, which is obviously driven by high mortgage rates. People don't want to move and give up that 3% mortgage rate, and affordability. We started the year with existing home sales running at 4.2 million. We're ending the year running, around 4 million. So you're seeing the higher rates relative to where they were a few years ago really starting to affect demand. You have seen the listings of new homes coming on the market remain very low by historical standards. So the months of supply has gone up a little bit, which should help home price appreciation, should help slow down home price appreciation next year to 3.5% instead of the close to 6% we've seen the last 2 years. So that'll help volumes increase. And in our forecast, we do have mortgage rates coming down next year, thanks to spread compression coming down to the mid-sixes.
You mentioned inventories. Just to double click on that, Mark, can you quantify that? What do inventories actually look like across the country?
So it's a very interesting to see what's been happening to inventories across the country, because they're actually starting to see quite a bit of geographic variation. If you look at states in the Northeast or New England, you see that inventories of homes available for sale, both the sum of existing and new homes, is at about 50% of the level that it was in 2019. And then you go to the Sun Belt, you look in Texas, Florida, some other markets, and now the inventory is over where it was in 2019. So again, that's where the new home sales market is really contributing and helping in those areas where you can build in order to have, more competition and more homes available for people to potentially buy when they go out looking for a home.
Add it up first, Mark. I'm just curious, national home price growth. What are you seeing next year? What do you forecast? I would imagine that also probably varies a lot regionally.
There is regional variation for sure. At the national level, we're looking for home prices to rise by 3.6% next year, which would be a slowdown from what we're expecting for this year, 5.8, and last year was 5.9. So we're predicting a slowdown in the rate of appreciation, but still positive home price growth. A key thing is that we're predicting that income should grow by 4%. So 2025 could be the first year in a while where incomes grow slightly faster than home prices, helping out affordability.
And finally, Mark, what about President-elect Trump obviously moving back into the White House there? His plans, taxes, regulation, immigration, are you taking that into account when you're making these forecasts for our housing market next year, or no, too much uncertainty to do that just yet?
So at this point, we do what we always do with any change in administration or any other policy. We only incorporate specific policies once we have the details, right? You have to see the legislation. You have to see the implementing regulations. So once we get more detail on the policy changes, we'll be able to implement that.
Mark, great to have you on the show. Thank you so much for your time.
Thank you for having me.
Stick around, more Ask for a Trend right on the other side.
Apple has released its second set of Apple Intelligence updates for iOS, iPadOS, and macOS. The new capabilities include ChatGPT integration, as well as Apple's new Visual Intelligence, which allows you to look up more about the world around you using your iPhone's camera. All of this is part of Apple's efforts to goose iPhone, iPad, and Mac sales, as well as better compete with Android competitors in the US like Samsung and those in China like Xiaomi and Huawei. I've been using the features for the past few weeks, and these are the 3 best ones. First, there's ChatGPT integration, which allows you to look up information through the chatbot using Siri. Hey Siri, ask ChatGPT what NVIDIA's stock price has been like over the past year. And then you can see it brings up everything you need about what's going on with NVIDIA, how much its stock price has gone up, and then that it's experiencing some volatility recently due to different investigations with antitrust in China and things along those lines. Second, there's Genmoji, which allows you to create custom emojis or memojis using the iPhone. And I'll type in, show a picture of me at a party at night. Done. And now it's going to populate. And then these are the different results that pop up. And it'll continue to generate them on the side there as well. And third, and my personal favorite, is Apple's Visual Intelligence, which incorporates both Google Search and ChatGPT into one interface. All right, got that. We'll do search with Google. See, it says it's searching, and then it pulls up exactly what this is, which I've never seen before in my entire life. You can get this kind of capability just from your camera. Ask ChatGPT what this is. So as you can see, this pulls up exactly what this is, a porcelain dinosaur, and it's telling us that it's a dish holder that combines functionality with a playful design. But the good thing about something like this, the ChatGPT integration, is that if you're looking at a plant, a piece of artwork, an animal, it will be able to tell you exactly what those are, just like it did here with our little T-Rex guy. Like I said, all of this is meant to get consumers out buying new iPhones, iPads, and Macs. While I broadly enjoyed the updates, there were a few hiccups here and there. ChatGPT not being able to find something that I wanted, or Genmoji not looking exactly how I wanted it to. The broader issue, though, is that software doesn't really get people out to buy things. It's usually the hardware, the displays, the cameras, bigger batteries. All of that being said, though, Apple Intelligence is still relatively new, and we'll just have to see what Apple cooks up for the next iteration of updates and whether that is enough to entice people to start shopping.
And we are finally able to pry Dan away from his iPhone long enough to tell us more about the new update. Joining us now is indeed Yahoo Finance tech editor Dan Halley. Dan, great to see you.
I just saw it myself. I look pretty
amazing.
handsome.
Great beard day, by the way. Thank you.
This is what the show should be.
That's an instant clap. That's what people tune in for.
I mean,
let me ask you this, Dan. Great review, by the way, as always. What's coming next? What new features does Apple have on the way that I need to know about?
So I think the big ones are a few. One is something called, we'll call it app intent or app intention. And basically it'll allow you to call up Siri to do something with a particular app. So, schedule this on my calendar right now, or, pull up XYZ in this app. The other thing is tied to that is more personal context. And so one of the examples that Apple had said when they announced this was, say you're going to pick up your mom at the airport, right? You say to your phone, hey, Siri, what time should I leave to, just making sure it's not doing anything, what time should I leave to get mom, right, from her flight? It will look at your phone, your mail, pull up when your mom's flight is, go into the Maps app, find out what the traffic's like, and then tell you based on your home when you need to leave to go to the airport.
Helpful.
And come back. It sounds awesome, right? That's like, to me, that's where the rubber kind of hits the road, right? The ChatGPT, great, because they need some kind of,
Have you found that useful, by the way, as you've experimented with it?
So the ChatGPT stuff is something that I at first was like, okay, whatever. And then the thing that I really like, honestly, is visual intelligence. I think that's awesome, because I also, I turn 40 next year, and I guess at this point in a man's life, you start bird watching is a thing. So now I want to know what birds are.
Relaxing.
So I like do that, and I find out like what plants are that I see around. So, apparently we have a bunch of fig trees or something in this office. Cool. But that's the thing that I think is really interesting. Plus, if you go to museums and stuff, you can say, what is this piece of art? What does it, symbolize? And it'll explain that stuff to you. So that I think is generally helpful. ChatGPT on its own, I'm not really asking many questions that I need an immediate answer to like that. I mean, maybe if it's related to breaking news about the Mets, maybe I'll do that. But, or if I'm trying to do something in a video game, I could ask that. But then I want to go and dive deeper into the sources. So I guess at this point, I'm a dinosaur because I really like still using Google and using search like that. But I do think it's very helpful. I think overall, they're going to continue to put in these types of features that make it more and more useful, right? When they came out with it, it was just notification summaries that I think were worthwhile. I don't really do a lot of photo editing, so that wasn't a thing for me. ChatGPT makes it more interesting. Visual intelligence, even more so. And I think, as they continue to do that, it's going to get more and more impressive until that point where you go, hey, Ma, I'm coming to get you. And the phone's telling you when to leave. So I think that's where it'll be cool.
Thank you, Dan. Always great to see you.
Beard off. I like that.
Stick around. Much more asking for a trend still to come. For our chart of the day, we are looking at the moves in small caps. And Yahoo Finance's very own Julie Hyman joins me now with a closer look. Julie.
What conversation have we had on the markets recently that hasn't involved small caps in some way, shape, or form? That's because so many investors have been calling for gains in small caps, gains that have not materialized. And today, the Russell 2000 fell some 5% after the Federal Reserve cut interest rates by a quarter point and indicated it might only be cutting twice next year. Why is that a big deal for small caps? Well, that's the subject of our chart of the day. So if you take a look here, this chart comes to us, by the way, from Ryan Grabinski over at Strategas, and he is looking at how much the cost to service debt is for small caps versus large caps. In other words, how many loans do they have, how much debt do they carry, and how much are they paying in interest on that debt? That's the question we're asking about these companies. Well, when you're talking about companies in the S&P 500, the large caps, they're paying about 4.2% right now. This is their interest expense as a percentage of their total debt. 4.2%. Okay, it's ticked up a little bit. But take a look at that same number for the Russell 2000 index of small caps. It's 7.1%, and we've seen it go up quite a bit here. So That might mean they have more floating rate debt as opposed to fixed rate debt. But in any case, that interest expense is going higher. It's costing them more to service that debt as a percentage of the total. That implies that there is a higher risk factor associated with the idea that interest rates are going to stay higher for longer, that we might not see as many cuts next year. It's also one of the reasons, perhaps, why you saw small caps fall today, and why maybe some investors' conviction or enthusiasm about small caps is waning to some degree. We talked to Tim Urbanowitz over at Innovator ETFs earlier today, and he said really you're going to see quite a lot of back and forth with the small caps next year, in part because of concerns about things like this, Josh.
All right, thank you, Julie. And that is a wrap on today's Ask for a Trend. Have a great night.